Okay, I have just after 1 o'clock, so I think we will get started here. Good afternoon, everybody. My name is Ian Campbell. I'm Vice President of Operations at PACICC, and I'm the staff lead for your Risk Officers Forum, and I'm your moderator this afternoon. So I want to welcome everybody. A special welcome to first-timers if you're new to the broadcast. And bear with me while I'm multitasking and I'm allowing people into the broadcast as I talk here. This is a very exciting day for us. It's our second online Risk Officers Forum meeting of the year in this new world of COVID-19. It's an opportunity for us to connect with our members across Canada, and we're very pleased to have 55 organizations joining us here on the line today. So welcome, everybody. We have a very exciting agenda. I want to thank Danica Hall, our operations manager, who's going to assist me on the broadcast by putting slides up and advancing those for us. So if I could ask Danica, could you go to slide number 2 in the PACICC deck? That would be great. And I just want to review for you while that's going up. This is essentially great, our meeting agenda for the day. So I'm going to talk about some housekeeping items. We'll touch on our speakers for today. We'll look at upcoming events and then the satisfaction survey. So first, before we get to our guests, let me go over some housekeeping items with you. The Microsoft Teams platform we're using today, we want to go over some ground rules to make this a productive meeting for everybody. So thanks everyone for muting your audio and disabling your video feed. This eliminates background noises which are distracting and also increases signal strength, which increases the capacity and the quality of the broadcast. So thank you in advance for doing that. Questions, you're going to see in your taskbar in Teams, there is a little icon. It is a hand like this. And if you click on that, as we go through the broadcast, we want to make this very interactive. So if you have questions for our speaker, it's probably best to take them in real time. And each speaker has an hour to go through their presentations. So that's lots of time. And we want to kind of strike while the iron's hot. So while you have a question, please put your hand up. I will recognize you. Ask you to turn on your audio and your video if you want. Introduce yourself, please pose your question, and then mute yourself again, and our speaker will address your question. Today's topics are very practical, thought-provoking, and timely. Very excited to have Mark White here, Chief Executive Officer of the Financial Services Regulatory Authority of Ontario, who's going to be our keynote speaker. That's followed, he's going to be followed by Stephen Dishart, from Dishart Communications and Crisis Management Consultants. And Stephen's going to be talking to you about contract language and lessons learned from the 9/11 litigation. We had the unfortunate 19th anniversary last week. And then following Stephen comes Paul Rand of Omni Bridgeway Canada. And Paul is going to be talking about third-party funding of litigation in Canada. I sent out with everybody, to everybody, just prior to the meeting protocol. And it notes that the Competition Act is in full force. There is no collusion with today's broadcast. No common approaches to business strategies. We're not going to be talking about claims adjusting practices, scopes of coverage, resolution of mixed claims, and/or management of third-party vendors and service providers. It's a very competitive industry, and it will remain so. The recording you'll note on the top is being recorded for future on-demand rebroadcast. That's going to be on our website shortly, so please watch for that. I'll be sending out a note to everybody that that is online and available. And it is being put on our website for members that are unable to join us here today. And of course, we're going to be sharing the slide presentations with you after the broadcast. On a personal note, maybe you could go to the next slide, Danica, thank you. Today was payday at PACICC, and I saw that funds were deposited and cleared through my account this morning, so I was very, very pleased. A very big cause for celebration in our house today. So I'm therefore absolutely delighted to welcome the person who signed that payment, who signed my check today, my boss and the PACICC President and CEO, Alistair Campbell. We're going to call on Alistair to provide some words of welcome and to introduce our keynote speaker. So if we could drop that slide, Danica, and Alistair, if you could activate your, perfect. Okay, over to you, Alistair. Thank you.
Thank you, Ian, and happy to be able to help the family. I am thrilled to see the strong turnout for today's Risk Officers Forum, and very pleased to see just how strong the agenda is. If you'll humor me for 2 minutes, just on the PACICC story. Like every organization, we've been trying to work out how to handle the curveballs of COVID and still execute against our plan and deliver on our expectations for our board. And I've been really pleased with the way our little organization has been able to do that. In April, we held a, I think, pioneering annual general meeting where the first material modernization in coverage and benefits since in some parts 1989, in some parts 2006, was strongly endorsed by the industry and approved by our board. So very pleased that that big work project from last year went through seamlessly. To change anything at PACICC requires the approval of 10 provinces and 3 territories. So we're harder to change than the Senate. And so we got full unanimous support from the regulators and got that all done in April. Our project this year is a deep dive into thinking about resolution alternatives, the opportunity for PACICC to engage prior to the actual failure of a distressed insurer, what that would look like. We've had the powers since we started, they've just never been used. And so we're having a consultation exercise with the industry on how that would work and what criteria would our board use to gauge their actions and determine yes or no. We send out a consultation survey and a consultation paper at the end of July. Feedback and results are due from the industry by Friday. We are getting a wave of votes in this week. And very excited about that exercise. We'll have a workshop with many of the top industry CEOs at the end of this month, and our board will make some determination on this at the end of November or beginning of November. Our number one long-term issue is still trying to get some form of strategic backstop to mitigate systemic risk for the entire industry in the event of a major megaquake in British Columbia or in the Montreal-Ottawa corridor. It's a long-standing file. COVID has illustrated powerfully why it makes so much sense to have a plan in advance, the kind of in case of emergency break glass plan actually ready for tail risk events. And so we are very optimistic that the events of COVID will help amplify to the federal government the compelling logic for doing something about another tail risk that could happen this week. Mother Earth is indifferent as to whether some species on the surface has a flu or not. If it shakes, it'll shake. And it would be very wise for Canada to have a better structured backstop than the absence of one that we have now. We've also made really good strides on some of our operational priorities. I won't bore you because I'm so excited about our guest speakers today. But if you haven't had a chance to read our latest Why Insurers Fail on the failure of the Reliance branch in Canada, it's a super reading. And as always, it's good to learn from failure so as not to repeat it. And we're very pleased with the work product that is coming out of each of these risk seminars, webinars, and fora. And we're grateful to the risk officers who are on our advisory committee and have helped us shape this agenda. So let's get to that agenda. It's my real pleasure to introduce Mark White. Reading his biography is unbelievably humbling. He is the full package. Business school, law school, accountancy training, worked in the private sector, Canada and the UK, M&A background, structured finance background, and then went to OSFI and was there for the financial crisis and was a key player in helping think through how Canada could best manage in those unbelievably uncertain times. We're very lucky to have had folks like him there at that time. He was part of the Basel III process, and I'm sure they're working on 4 someday. But for now, I think that's held up pretty well and been road tested vigorously through COVID. So far, so good there. Left OSFI and went to BMO, ended up exactly in our line of business as a senior VP and head of enterprise risk. before joining FISRA in May of 2018. It is a special thing to have someone so uniquely qualified, and Mark was the unanimous consensus selection to be the first CEO of this new entity, in which a lot of our industries place great hopes for better than before. And so it's been an incredibly busy first year for that organization, and I am very eager to hear Mark's update on what has been achieved in that first year and what comes next. Mark, thank you for joining us today, and over to you.
Thank you very much, Alistair. Can you hear me all right?
We can.
Excellent. Well, thank you for that very kind introduction. It's always humbling to actually hear my background read out to me, except that then it makes me wonder, is it that I can't keep a job or I don't know what I want to be when I grow up? Well, hopefully it's not just that I can't keep a job. I do have lots of interests, and I love being at FISRA because it is a great place where we focus on risk, and we're trying to do something different. It's about regulatory transformation. Our organization is just over a year old at this point, and we essentially had two legacy organizations, FISCO and DICO, and so we launched in June 2019 with 200 vacancies out of a 500-person complement. So that, of course, added its own challenges. We have a somewhat of a unique structure in that, coming from the background. Oh, and you can go one more slide on, because I'm getting a little bit into why FISRA was created. We have a bit of a unique background that when there was International Monetary Fund report, Auditor General report, and then an expert panel report formed by the government, and they talked about the need to have a different sort of regulation in Ontario. And it's primarily a reflection of what goes on in the financial services we regulate, and particularly the P&C companies that PACICC serves. The amount of innovation and change going on in financial services, and that's both change in the products and how they're being consumed. It's how the services and products are delivered. And it's also, and you pointed out some of them, Alistair, in your opening remarks, that the risks continue to evolve and change. Insurance has been around for a very long time, but it's always fresh because it's always changing. And for a regulator to be successful in an area where there is constant change, the regulator needs to have the tools, it needs to be able to adapt, it needs to have that culture, it needs to have the organization. And so when FISRA was founded, the idea is that we would have a more independent regulator in the past. Obviously, we only have one shareholder, the people of Ontario, represented by the government. And so, we have to be responsive to our shareholder, but my board of directors, who is hired by the government, and I'm hired by my board of directors, and then we hire our management team. So we have a fair bit of operational independence. We, of course, are in constant collaboration with the government to understand what their views are on issues. Sometimes they have the lead if it's a change of law, but if it's actually the application of law, the operationalization of it, it's our responsibility. So today, I'm going to reflect a little bit on, a little more on how we got founded and why and what we're trying to be as we grow up. Talk a little bit about what we did during our first year. It's been a very busy year, and obviously COVID-19 has thrown us a curveball, just like I'm sure it has thrown all of you a curveball as well. And then I'll talk a little bit more, sort of looking forward, about how we want to continue to mature as a regulator, some of our priorities and our key initiatives. Danica, if you don't mind going to the next slide, please. So I talked a bit about change already. So, change is one of the only constants that I think we find in financial services and regulation. And I'm keenly aware, both from my time as a regulator, my time as a lawyer, even time as an investment banker, or running BMO's capital or enterprise risk functions, that the amount of change going on in financial services can be almost overwhelming. And it's very important for risk managers like all of you are, is to make sure that you're embracing the change and trying to stay with it, and that you're channeling it. You can't stop change. Change will happen without you, whether you like it or not. And so as a regulator, what we try to think of is our model is of an ecosystem. And so we are a player in the ecosystem. And if any of you remember your grade 10 biology, Everybody in the ecosystem affects each other. And so a well-functioning, healthy ecosystem actually has the different component parts that are working together, sometimes in competition, sometimes in common ends. You know, you talked about competition, that you are a competitive industry, very true. The regulator doesn't compete with you, but we have common ends. So I look for the commonalities and I look for the differences. I look for the places why the regulators have to exist. And when you've got the need for national harmonization as we have, which is built right into our legislative agenda, when we have new entrants who are trying to come in, when we have concerns about consolidation in some parts of the marketplace and maybe not enough competition, and in other places, some people would say there's almost an unhealthy competition or competition that is negative for the public. And so we've got all that on a background of tremendous innovation through technology, and the way people want to consume their financial services is changing. And then most recently, the COVID-19 disruption. Danica, the next slide, please. And so you put all these together, and it is a huge, complex problem, which is why I was delighted when I got the call to come in and talk to them about being the CEO of FSRA. When you look at, and this goes right back to the Auditor General report, the IMF report, the expert panel report, they realized that the regulator had to be different. And a lot of the things I'm going to talk about today are going to be about some of the differences we've been trying to achieve at FSRA and how we've been living them in our day-to-day business. Danica, next slide, please. So, first of all, a little foundation. This is a bit of a précis of the Act, but it gives you an idea of the breadth of the regulation we have. And, you know, my elevator speech, when someone says, what do you regulate? And I say, it's everything except for securities that is provincially regulated. And for most people, then they kind of get that, but they don't really. But here's a bit of more of a drill down, because our objects hold the key for what we're trying to achieve. It is about regulation and supervising all the regulated sectors. It's also about cooperating with other regulators. It's about making sure we understand what goes on in our ecosystem, because we help to manage that ecosystem along with the government, along with organizations like PACICC. It's about making sure there's public confidence so that the bonds between the industry and the consumers who deal with that industry and the other stakeholders that rely on that industry. You know, COVID-19 has called into, you know, or highlighted just how important insurance is. And, you know, everything from the issues about, you know, travel coverage, cancellation, should there be immunity for COVID-19, can you get coverages for business interruption? Those are tremendously important issues of risk allocation and loss distribution, and they actually are fundamental to making sure that the economy can function well. And it's very difficult for anybody to have foreseen exactly how this pandemic has unfolded to date, or to forecast how it will unfold in the future. But, you know, organizations like PACICC and you folks as risk managers, you know, you are basically in the job of trying to understand how those risks can unfold. And so when I was at BMO running enterprise risk, responsible for everything from disaster recovery, operational risk management, stress testing, all of our risk modeling. It's a daunting task, though. I can't say that we did run some pandemics as scenarios, but I can't actually say that any of them really reflected, you know, where we are today or where we may end up a year from now. What I can say is that by doing that work, and I had a coach once who said, you end up playing like you practice. And so that's what he meant by that, is that when you go out and you run different drills, you put yourself in different situations, you develop tools and resilience which allows you to deal with those problems. And so as a regulator, we're also trying to do that. And we do that through transparency. We try to be a very transparent organization. We try to be clear about what our objectives are and what we're trying to do. And we also, when we're drilling down and we're talking about things like deceptive conduct or practice, bad practices are bad for the reputation of the industry. And so what I see is I believe there's a tremendous alignment between the sectors we regulate and the regulator. You know that your customer bonds and your reputations are your most important assets. And so to the extent we may not always disagree on what we think is good conduct or bad conduct, but that's around the margin. The vast majority of things we are in alignment about, and our views on how we think the industry should be operating from a conduct point of view, or what are just and reasonable rates, or for the prudential insurance, we do a small insurance prudential as well. All those things, the large part we will be aligned with the sector. And on the pieces where we don't fully align, that tension, as long as it's constructive and healthy, and we're talking to each other and sharing open, honest views, and trying to come to an overall best result in the public interest, then I find that the regulator works well with the other players in the ecosystem. Danica, the next slide, please. Quick overview, you can see the different sectors we regulate. Financial advisors and planners is a new area we've been asked to take on, so we're in the middle of doing that. So property and casualty insurance, has different facets to it. The auto insurance, not only are we the conduct regulator as we are for the rest of PNC, but we also are the rate regulator, and that has its own challenges as you can well imagine. There's been a lot of press about costs going down in the auto area. We have been taking some active steps to make sure that insurers are looking at their cost structures and trying to make sure that that the rates are just and reasonable in the context of the COVID-19. And, just sort of building on that a little bit more, we've actually worked with government. There were prohibitions under the Unfair Deceptive Acts and Practices regulation. We worked with the government to get those lightened up, because arguably giving money back to your customers because they weren't driving and they weren't a risk could have been considered an unfair or deceptive act or practice, which clearly was not the intent, because that's not in the public interest. So auto regulation is a big piece. I'll talk a little bit more about some of the conduct regulation that we're looking at doing, because that is also very important to making sure that there is trust and confidence. And there is a bit of prudential supervision, as I mentioned, that we do in the insurance sector as well. I won't go into the other sectors. Why don't we go to the next slide, Danica? A little bit of how we think about ourselves as an organization. So, we're an organization that's committed to continuing improvement or continuous improvement, and you have to do that through having effective challenge internally. And so we think about the outcomes at the top of the curve, if you will, and what we're trying to achieve in our regulation. And we're trying to focus on where are the risks to effective financial services delivery and to the public. We, of course, think about our organization, the advancement piece. We want to make sure our operations are efficient and effective to achieve those goals. And of course, like all of your organizations, talent is the key. At the core of all this is that we have to be empowered by being a principles-based and outcomes-focused regulator. And what I mean by that is the old view of regulation, where you had a list of prescriptive requirements, and it was more of a compliance focus where you could take a checklist to almost any issue and say whether it was black or white. The world, as it changes, that form of prescriptive regulation no longer works. You need to focus on, you still may identify certain events or acts or circumstances which are hallmarks of problems, but you want to test them on a principle, understand the principles driving what created that list of events or acts or circumstances, and you want to test them against the outcomes that are being achieved. And that's why we talk about principles-based but outcomes-focused regulation. A little bit more on that later. Danica, next slide, please.
Mark, hi, it's Ian again. If I could just interject here for a quick second, just to remind our viewers out there that we'd like this to be conversational. If you have questions as Mark goes through his presentation that you'd like to ask him in real time, please use that raise your hand icon in your taskbar there, and you'll be recognized and you can pose your question as we go through. So thanks so much. Back to you, Mark.
Yeah, that's Ian, great point. Of course, I invite questions all the way through. So our foundation, we set a vision, mission, values. Our vision is about financial safety, fairness, and choice. And our mission is public service through dynamic, principles-based and outcomes-focused regulations I just explained. And so the enablers, we have rulemaking power, which is the power for my board to make law, still with the minister's approval, but essentially doing the work that the legislature would normally do. Our guidance, and I'll talk about our guidance framework. I've talked about being risk-based, and that means that we need facts. And so I try not to operate in theory unless we have a confluence of that in theory something might be a problem, and we can back that up by actual evidence And ideally that could start with anecdotes or complaints, but we essentially want to be able to go and look broader than that. And I'll talk about some of the work we're doing in the conduct side. The dynamic is just the fact that this is an evolutionary process. The collaborative, consultative, transparent, that's how we engage with the sector, with the ministry, with other regulators. And I already talked about the operational independence. Danica, the next slide, please. So two big themes that run through what we're doing. One is burden reduction, or another word for that is efficient regulation. And the other is about effective regulation. And so all of our priorities are basically driven by these overarching themes of regulatory effectiveness and regulatory efficiency. And then we drive that down into each of the sectors, and these were our year one priorities you have on the screen here. And it's about in the sectors for P&C and auto, it was about the streamlining the rate regulation process, supporting the government in its auto reform strategy, looking at the role of health service providers, and a little broader, looking at fraud and abuse in insurance and generally, and also auto in particular. Danica, next slide, please. So a very busy first year. As I said, we were significantly undermanned, 40% vacancy rate almost when we started. And we've had extensive engagement with the public. We've formed stakeholder advisory committees, one of our most important groups, because they meet not only with management, but our board wants to hear directly when we're forming our business plan and when we're evaluating success against our business plan. So what should be our priorities? Where should we be spending our money? Our board wants to hear from each of the sectors through these stakeholder advisory committees. So a very important thing. And you know what I learned when I got the job and spent about a year before we launched, initially, you know, employee number one, nobody else in the organization except for my board of directors, is that if I listen carefully to the sector participants, they actually will tell me most of the things I need to know. They may actually have different views on what the solutions are, but they're very good and consistent at identifying the issues. And we also worked very hard at looking at the inherited guidance framework, and it was actually beyond that as well. So we also looked at all the data requirements, the filing requirements, the licensing regimes we inherited from the two regulators that were legacy regulators. And we basically realized we not only had to put out some new guidance, but we had to go back and rethink those foundations. And that's a tremendous amount of work. Danica, could you go to the next slide? For example, there were over 1,100 pieces of guidance that we had to review. I can't say I've reviewed them all personally, but we have had knowledgeable people, and we have a bit of a matrix approach. So different regulators are structured differently, but what I've found is you need to have a creative and constructive tension between the core regulatory groups, so the pension, the auto rate, the P&C, conduct, those are essentially our core lines of business, and then the groups that support them, the regulatory support areas. So legal will have a perspective on certain issues, and sometimes we even have the lead on them, or our policy team, or our communications team. So those functions that support, we want to make sure that you are essentially getting the best of both worlds so that we have effective checks and balances internally. As risk managers, you'll understand the power of having good processes and having controls. And we applied these as we reviewed our guidance framework, and you'll see that we reduced about half of the guidance that we inherited. We were basically able to say, that's not necessary. Often it was just things that were duplicative or things that, you know, had been outmoded, but no one had thought to pull it off the shelf and say that's not live anymore. And in the auto P&C, that was over 280 pieces of guidance. And so if nothing else, you know, we're cutting through that thicket, and we're now on the process of making sure that we identify the key pieces of guidance, and then we renew and reissue that guidance as we're going forward, as well as building new important pieces of guidance, for example, like the standardized auto rate filing process we introduced. Danica, next slide, please. This is our, you know, our own self-assessment, but we did talk to both our board, other stakeholders, including those stakeholder advisory committees, about how we did. And we think we did a pretty good job on our inherited guidance review. It's, you know, going to continue on, but it's now become part of our normal course. We've got service standards, which we pretty much had ready to go, but then COVID-19 hit, but we're basically in the process now of putting those out. And those are basically ways we can measure ourselves. And we want to hear from the industry in this consultation that will be upcoming, whether we've got the right service standards, not being too easy, too tough on ourselves. And it's everything from, how quickly we deal with a consumer complaint, acknowledging them, what's our path to, taking first action and then finally closing the file and putting parameters around that, to dealing with things like how we're going to deal with more substantive regulatory filings. So we are trying to set those service standards. From the regulatory effectiveness, most of these continue on. Modernizing system and processes will continue. Our stakeholder collaboration, we are quite comfortable that we're on the right foot there. So that's what we call an ongoing normal course priority rather than a specific one we're calling out. Innovation will continue on in the future. Sectoral expertise, we're pretty pleased with how we've built that, but frankly, we always need to renew our contacts with the industry. So any of you out there, we're always looking for a few good people. And overall, protecting the public interest is probably an effectiveness objective that will never go away. And I'll talk more about that later. Within auto, the streamlining of the rate regulation process, we think with the standardized rate filing and even some changes we made to the major filing regime, which are ongoing, we think work well. The auto reform strategy is a work in progress because it requires government action, and the budget was delayed, and we are hoping for more of this in the fall economic statement upcoming. We've completed a review of health service providers, but now, of course, we have to execute on what we think is a more efficient model for their regulation. And the fraud and abuse strategy, particularly within the auto area, we made good progress, but that is a work in progress, which will continue. Danica, next slide, please. Now, I referred to our guidance framework, and I won't get into the details here, but we think it's very important that when we're reviewing all this inherited legacy guidance, that we're able to articulate for our stakeholders the continuum of the things they're going to see from us and from government and what they mean to them. And so everything from a legislation or a rule which is legally binding to a decision which is specific to a company, but we're going to be adopting a much more transparent, where decisions which used to be made in the private, we'll make sure they're put out in the public realm, perhaps with key details redacted so competitive information isn't out there, but so that people will know what the regulator is thinking, what we're doing, so that it isn't like private deals being struck. And then in the middle, we're trying to be clear about when we're interpreting guidance, which we issue interpretive guidance, which is basically us telling you what we think the law means. So we intend that to be the interpretation of law versus things that are just information versus our approaches. We want to be transparent about how we're going to supervise or regulate an area. So approaches is our way of talking about how we'll do things and how we'll exercise discretion that we have. Danica, next slide, please. COVID-19 obviously threw a curveball to everyone. We did some things on the fee side. We wanted to make sure that the public interest was served. So you guys did a great job in continuing your operations. It's surprising how little we heard about any of our regulated sectors, but including the P&C insurance sector, about customers being upset because they, claims weren't being processed and things were disrupted. Sure, there's going to be some natural disruption when things can't be done in person, but all in all, I think, the industry, the sector acquitted itself extremely well. We're also looking at how we then do some of our field conduct regulation, because we're not going out and doing on-sites the way we used to. And we're learning that we can do more indirectly. And part of that is also part of our modernization, our digitization processes as well. And then within the P&C and the auto specifically, I mentioned some of the things we did to make sure that we put in an emergency rate relief regime, so that not only could rebates, which I talked about earlier, could be given to auto insurance customers, but in fact, we actually wanted it to go broader than that, so that there was a complete range of tools, and we tried to highlight that in some of the guidance we put out during the crisis. We've also, we held an auto insurance P&C teletown hall to talk about things. We put out new interpretation guidance on accident benefits claims, because obviously you can't, during the height of the COVID-19, people were not able to go get treatment in the normal way. We've worked to identify what is the consumer relief being available. We put out information on that. There's more to come from another follow-up survey we've done, so stay tuned. And And we did some very practical things around the education, the licensing, and we realized that we probably are not nearly digital enough in the approach we have to licensing, to continuing education, to entry-level qualifications. And so that's something that we're looking at improving in the future. Danica, next slide, please. So I mentioned principle-based regulation earlier, and I defined it as being the opposite of prescriptive regulation, where it's very black or white, and where it's about understanding why you are regulating and what the law is trying to achieve, and testing that against the outcomes that are actually there. This movement is not just a regulatory movement. It's actually what I believe is the movement of well-run organizations from a risk perspective. You should no longer be trying to just say, the regulator is making us do that. A sophisticated organization asks, why does that rule, why does that regulation exist? And so what is it they're trying to achieve? And so how do we internalize that? So not taking on, too much risk or undiversified risk, or not pricing properly, not reserving properly. There's all kinds of decisions that businesses make all the time, which are in themselves principles based. And you judge yourself not by a arbitrary standard. You judge it based on the circumstances and judgment, taking into account all the data and analytics that are available to you. And so as organizations we regulate understand our approach to principles-based regulation, we believe that's a lower cost model for regulation, because it should align with what well-run companies are already trying to do. So instead of it, and that's why we have to be so consultative up front when we're creating guidance, regulatory or supervisory regimes, because we want what the regulator is going to be interested in to align to a very high degree with what the well-run companies in the sector will want to do. Next slide, please. A little bit of a quick example. Sometimes people don't completely get the difference, because principles-based regulation, you can do it through rules. They're just not prescriptive rules, right? So regulation, do we mean no rules? No, we don't mean no rules. So what we mean is that the rules will achieve the principles and articulate the outcomes. And so the simple example is, a speed limit says don't drive 90 miles an hour, or 90 kilometers an hour, sorry, being more modern here. That's there. Why? Because people want safety on the roads. You want to be able to get to your destination quickly, but in a safe way. So it's about safety. And the truth is, 90 kilometers an hour is safe in some circumstances. And frankly, arguably, maybe more than 90 kilometers if there's not a lot of traffic on the road, you're a good driver, great conditions, good vehicle, new tires. You might be able to drive in a little more than 90 kilometers and it could be completely safe. So 90, though, they picked as an arbitrary number to try and get safety. But the truth is, when the conditions are unsafe, 90 could be a crazy speed to drive. Snowstorm, new driver, poor visibility, car brakes don't work, tires aren't, in good shape, don't have winter tires, for example. So the point of principles-based regulation is to understand what the rules are trying to achieve, share that transparently with those who we regulate, who benefit from the regulation, so that we can all step back and try and achieve the right outcome. In other words, safe driving in the case of the speed limit, and focus less on whether it's 90 kilometers an hour, you're wrong, or frankly, maybe it should be 70 kilometers an hour, depending on the conditions. Danica, next slide, please. So some of the key things to make sure you're going to be successful. So part of it's about the regulator. So it's training for us, how we approach our guidance framework. It's also about adoption by the regulated entities. And so the risk management teams within organizations, if we're not aligned as a regulator with what you're trying to achieve, we want to know about it, because then there is a risk that we're actually imposing regulation which actually doesn't help you manage risks that are important. We might identify that it's something that the company doesn't think is important, but it's still thought important for other stakeholders. But generally, there should be a high degree of alignment between the way you want to run your businesses and the way we want to regulate your businesses. That also comes down to good processes, the systems, the technology, controls. And so our focus is going to be increasingly on your good processes and your controls, rather than on the complaints, which are really the anecdotes. So they're the tip of the iceberg if there is a problem, or they could just be, frankly, an isolated incident. And so what we're interested in is understanding, by looking at your processes and your controls, do you actually have a machine that should be self-righting? Or is it something that, basically is a compliance mentality where, it's going to be on an issues by issues basis. And so bad actors can be allowed to flourish because they don't actually have suitable controls around them. Products that aren't well conceived could be put to market because you don't have rigorous controls around that. And to do that, we have to have credibility. And I talked about that was one of our first year priorities, is building that expertise. And, we've made good strides. I'm very proud of the people we've brought in, but we always need to continue to build that expertise. And we need to be empowered. And I talked about rulemaking, which is important, empowerment, use of discretion so that we can basically use our judgment. So we're going to be taking the Unfair Deceptive Acts and Practices rule, for example, regulation. We have rulemaking power over that. And if some of you we may have talked to already, we're just starting some targeted bilateral consultations, but we're going to be looking at redoing that regulation in a way that is more principles-based. For example, we want to see that being less of a barrier to innovation. I already talked about how that UDAP rule was a barrier to giving money back to customers through rebates during COVID-19, when that's a goal that everybody, of course, wanted to achieve. Danica, next slide. Focusing on the public interest, we also are trying to make sure we have a balance in our perspective. And one of our main ways of doing this is our consumer advisory panel. And it essentially is part of our policy team. And they basically will perform the outreach function, and they will basically make sure we're in tune with the stakeholders. Because there's what I learned during my listening tour before we launched FSRA is it's very, very difficult to get a handle on what the public is saying, what the consumers are saying. And so you probably know that in your own business. Consumers are an incredibly disparate group, and it's very hard. And what happens also, there are some that are very vocal, usually because they've had an issue or feel harmed. So it is getting that input from the consumers, we think, is a very important thing. We're looking to align ourselves where possible with the different sectors to try and understand what is in the public interest, and trying to help formulate, even to have this consumer advisory panel. You can see that it's a very good group we have, very well represented across our different sectors. And, that's not the end. We've already held meetings that the consumer advisory panel has been the core of, but they've brought in people from different sectors to talk about specialized issues. Danica, next slide. Innovation I've also mentioned. I won't spend a lot of time on this, but a regulator who actually, first of all, we have to be empowered to do it. So that could be through, we have tools, we're willing to write no action letters or have forbearance agreements, but what we really want to have is having the powers to grant exemptions for temporary limited trials, and the ability, for example, as I talked about under UDAP, to basically say, in our discretion, you can do something like a rebate, for example, because it actually isn't anti-competitive. It isn't discriminatory. It doesn't violate one of the public interest standards. And so we're trying to create an innovation office. Well, we have it created, and we're basically building the framework. We're going to be consulting on this, where we can make sure that we can remove the friction that exists from innovation. And innovation is both something that happens incrementally with existing players, where they're wanting to test the boundaries and change their products and services and delivery. It also happens by new entrants. And so, that's a little more threatening, but we don't want our consumers in Ontario to have less choice. And we don't want to see a situation where, we essentially fall behind. And I've actually had, senior people at insurers, including P&C insurers, talk about how Ontario, in their view, is not a good place to innovate, because it's difficult to get a trial. It's to get the permission to do it. And so we have too many barriers to that. So we need to be able to collaborate. We need to be able to listen, and we need to help the industry advance its legitimate goals, while making sure that when we run those trials, that we're protecting the public interest. Danica, next slide, please. This is just kind of an interesting way to think about our innovation office, that we're sometimes going to be, a challenger internally and externally, or coach innovation.
Oh,
I think we got a little bit of background noise, unless that's a question. I'll continue on and hopefully speak over that. It's also a connector and a champion of innovation. Connector, where we want to be able to put ideas and connections together. And part of that is our innovation regime. We plan on being extremely transparent. So I already talked about decisions that they shouldn't be private. You should know what the regulator is saying when it makes a decision for one of your competitors or a new entrant. Well, same on innovation. So we won't give away the competitive information, but we'll want someone to know if we're going to say, well, you know, there's a rule right now which says in auto insurance, the customer is supposed to get the lowest price that's available from all the affiliated insurers. Well, maybe there's a situation where the innovation with a new distribution model and its pricing will be different, but it doesn't actually mean that it's for every customer. And so we want to be able to have the flexibility to do that. So we will be transparent, though, if we do that, so that if we make that exception for one company and they're allowed to run a trial, that others who are interested also being in that space will have the same opportunity. Danica, next slide. So our year 2 priorities, I won't spend a lot of time on this, very similar. This is the year we're currently in. Information sharing with other regulators was a new thing we've realized we had to highlight. And also we called out the transformation to principles-based regulation. And actually, if you go to the next slide, it's probably a better one to talk about the P&C and auto. We distilled it down to 3 key property and casualty with an auto focus about protecting and empowering consumers, about supporting reforms, and also having a better data and analytics strategy. And we think we've made some good progress on this. As I say, the budget was delayed. COVID-19 has delayed things, but we're getting a committee together on rate regulation and data and analytics. We do have a better process for setting rate regulation loss trend benchmarks in the auto. And we think that's very important because we should have that information. First of all, we should consult with the sector before we set what we think are benchmarks, realizing that it's a benchmark. It's not going to be the same for every company, but we need to have a dialogue on that. And so we've established that. And then we also realize we have to be transparent so that auto rates are going up. And some of the interesting things is they're going up in large part because of the physical damage accident costs, because autos, even though they're safer, are more expensive, and also a lot of traffic, so maybe there's more accidents, so you have greater frequency. But some of the reforms that have been made on the injury side, the personal accident injury side, costs are actually holding the line or even some cases going down. And so how a consumer chooses their insurance bundles, so the extent that they buy up protections for the physical damage to their vehicle or they have a more expensive vehicle, they're going to reflect those higher cost trends. To the extent that they're buying more minimal property loss coverages but are more in the accident coverages, well, their costs may be more constrained. So I think it's important that benchmarking initiative that we're getting that information out. I've already mentioned the UDAP, usage-based insurance. We want to see a more flexible regime. There's a prohibition on essentially a full costing model, so only discounts can be offered, and we think that's inhibiting it. We firmly believe through the COVID-19 crisis that the advantages of more usage-based, including pay-as-you-drive, as well as usage-based in the sense of how do you drive, that both of those, because people who were driving started to drive faster and more dangerously, even though there's a lot less driving. So we think, that's a very important development that needs to be allowed to flourish within the Ontario marketplace. And take all comers. So that's something we're working on with REBO. We've heard anecdotally that people are not honoring the take all comers rule, and we need to find out whether that's isolated incidents, just rare anecdotes that come to us, or whether this is something that's across the system, because that's not the regime we operate today. We have a residence reference panel on auto, which is we've got a survey out, and that panel's being formed. It'll operate this fall. Unfortunately, not the in-person events will probably be virtual. But this is to actually get people, again, trying to capture that very elusive consumer voice of what they actually think of auto rate regulation in Ontario. And simplifying some claims forms, and we continue to work hard on the fraud and abuse, and that includes health service providers. Danica, next slide. So let me just wrap up now, and if there are questions at the end, I'm glad to take them. FSRA is very much a work in progress. We've had a very busy first year. We're in the middle of a very busy second year. Thrown a huge curveball by COVID-19, affected us everything from how we communicate with the public, how we license people. We've had to take manual processes and make them electronic. And we've actually, I think, done a very good job at that. We've had to roll with the punches, and it set us back a bit on some of our core priorities, but we're now picking up steam. Interestingly, as we talked to the sectors, the feedback we got this summer in June was, you know what, because we postponed all of our consultations and our new guidance, and all the sectors, including P&C and auto, they've told us, no, get back to work, guys. What you're doing is important. Your priorities matter to us, and we need a regulator that's engaged, that's transparent, is pushing the ball forward. So it's it's going to be a lot longer before we can declare success. I am pleased with what we've gotten achieved in our first year and our first half of our second year, but we can't do it without you. And that's why our model is so transparent, why we engage so much. So I hope that when you and your colleagues are asked to participate, whether it's our rate panels we're setting up, or the data and analytics, or the work we're going to do on UDAP or user-based insurance, that you will help commit the resources, because it is through leveraging ourselves off your expertise that we're able to make better decisions ourselves, and that we're able to give better guidance to the government on a wide range of topics, including things like, what is the right immunity regime for COVID-19 as we want to encourage businesses to operate. So with that, I will see if there's any questions from the audience.
And I see Alistair has one, so Alistair, let's go to you.
Thank you, Ian, and thank you, Mark, for that very comprehensive and incredibly refreshing update on the hard work your team has been doing. I guess naturally curious, because there was such expectation about how different FSRA would be from FSCO, and yet the reality is that portions of what FSCO was doing were the law and its enforcement, and not that discretionary by the regulators. Can you give a couple of examples where there are things that FSRA thinks would be the right thing to do that will actually require the government to change legislation? Or would it be fair to say that as a general rule, you're comfortable that the things that you're trying to accomplish that would be in the interest of the consumer can be done entirely by rule-based adjustments?
So it's both. And so there are areas where and I've been internally very difficult on people who have said, without those additional tools, we can't do anything. We need product reform for auto insurance. If you don't reform the product, there's nothing you can do. And the truth is, I said, well, that's maybe not completely true. How are we setting rates? Are we giving companies the flexibility so that they can actually know that they could get rates changed? Greater certainty of the process, shorter turnaround times, because if companies have an expectation that's very difficult to change rates, it's like a battleship, then they're going to be less interested in taking some risk in actually responding to market conditions. And so that's why we offered the standardized rate filing process in the crisis. We offered emergency rate filing, basically a file and use regime, and our 30-day turnaround on the standard filing. So that's something that was within our control. And I said we have to act on those things that are within our control. Fraud and abuse. There's clearly a data side to fraud and abuse, which may partly be outside our control, but some of it's within our control. We're actually in the midst, I can't remember how public this is, so I won't overstate it, but for service providers to insurance companies, where we believe they have violated UDAP, but they're not actually a regulated entity. It could be a tow truck driver, it could be a service station, right? It could be a health service provider. We're actually doing things to create test cases where we'll test whether we can effectively sanction those individuals, right? And so we'll find out whether the courts will support us in doing that, and then we'll find out, do we need legislative change? Even if we don't get the legislative change, though, if we could actually create that information database on who are the bad actors and work with companies, And so some of that already goes on within the industry, but then we'd be able to get that information out there, and we want to be able to support things like provider networks, right? If that can bring costs down and give better cost control, maybe better service to customers, we want to be able to support that. And so then you start to get into some of the things like I talked about innovation. Right now, we can write a no action letter or enter into a forbearance agreement saying that if you offer this product or service, we won't take action against you, but we can't tell you that you aren't violating the Insurance Act. And so that means that's one of the reasons why a lot of insurers say to us, Ontario is not the place to innovate. Because sure, you're saying you won't come, but the regulator could change, or someone could actually bring a private action for a breach of the Insurance Act, right? And so we believe we need exemptive powers to permit innovation across a whole bunch of things that right now are prohibited. Not that they shouldn't be prohibited or restricted, but that you need to have a regulator allow on a trial basis flexibility around those. And so then there's other areas like UDAP where it's a great example of rulemaking. So, a lot of people say UDAP stops innovation and stops competition because it's very prescriptive. But we have the power already to write that rule, and that's why we've taken that on, even though it's an incredibly complex topic. So to your answer, Alistair, there's a whole bunch of problems out there, and there's a whole bunch of solutions. And what I'm focused on is the solutions are within my control. And where I believe the solution is not within my control, it's my job to work with all the stakeholders to reveal what is the problem and what is the real range of solutions. And because I do believe we have incredible support from the government, even with the distractions of COVID-19, there is great support to make sure this industry functions and functions well from an economic point of view, from a jobs point of view, and primarily from a consumer point of view. They want to see those products and services offered. So I think we're all aligned. We actually have way more things that we could work on. And so when we don't get, when the budget was postponed, sure, we were disappointed because we expected some things to be in the insurance, particularly auto file. But I said to people, we have lots of other stuff to get going on. So don't worry about the problems you can't solve that are outside your control. Take responsibility and solve the problems we can, and bring the ball as far as you can on the problems we can't solve, so you make it easier for the other people who we have to work with.
And I'm going to ask other members, do you have any questions for Mark before we wrap things up here?
I see a hand up. MB.
Very informative presentation, Mark. Thank you very much. I know members that couldn't be here today will delight in going through your slide deck. So thanks very much. Great messages about principles-based approach. And we do an ERM survey every year, and government regulation. Sorry, Maz Bound has a question. So let's take this question, and then we'll. So Maz, can you please unmute yourself and ask the question?
Yes, of course. Sorry, it's and it may not be a very long question. Mark, I was really interested in the conversation, in particular around FSRA's support to innovation in the market, and I really do want to see that Ontario is helping to lead the way there. I wondered if the extent to which FSRA has reviewed and seen what the FCA in the UK has in respect of their regulatory sandbox, because I think it's a really transparent model in terms of being able to support people and firms that would like to try a new product or try a new service, give them access to the market and support them with the regulatory advice and help that move through and hopefully get it to market in a way that then helps the market to keep up with the demands and the needs of the consumers. And I wondered how your innovation approach compares alongside that type of model, or whether you have something that's similarly structured or are thinking in that way.
Maz, it's a great question. And I wish I'd gotten a debrief, because we actually had a call, our auto PNC with the legal and policy supports with the FCA yesterday. So we've spoken with, or are speaking with in the next, because we're finishing these off, with the FCA, Netherlands, some US jurisdictions, I think Singapore. So we've actually, through talking to our legal contacts, and We've identified the regulators we think are quite good in the innovation realm, so we are actually benchmarking all of them. And we're also talking to regulators in Canada who also have innovation regimes. It could be other provincial insurance regulators, and we don't think anybody has the perfect answer yet, but we're learning from them all. And I would say our model will be, I only know a little bit about the FCA, so I may be misstating this, but ours is probably intended to be a little more flexible than a regulatory sandbox, where often there's a desire by the regulator to predefine parameters, and anybody can come in and sort of operate within those parameters and run a trial. We think a bit better model is if we're actually given some exemptive powers for innovation and some discretion, let's say through the UDAP rule we're remaking, where we can actually allow companies who want to innovate to come to us. We will help them identify the regulatory barriers to that. We'll make a determination whether they think it is in the public interest, and then we will give them a proactive, exemption order or ruling under our discretion to allow them to have their customized. So we just think that it's better than us trying to spend a lot of time anticipating about how we should describe a sandbox. Because some of the regulators we talk to where they describe the sandbox, they say, we're actually really disappointed that not that many people have come in and worked within the sandbox because there was one part of their product or service delivery that actually didn't fit within the sandbox. So they kind of felt that it wasn't there for them, or that they just had trouble. So we're going for a bit more of a flexible model. We do actually have an innovation team that's going to be out consulting on our innovation framework very soon. We were doing that benchmarking before we did that, but we're sort of drafting our innovation framework. We're talking to the ministry. We're doing the UDAP rule. So those pieces will be coming together within literally the next few months.
Great. Thank you. Thank you, Mark.
Okay, well, thank you very much, Mark. We will share your slides with our audience and members that couldn't be here today. So thanks very much for being with us today. Great explanation and very timely with the turn of your first anniversary to come in and talk, reflect back on your first year of operation and the many great things you have going on, and give us an idea of what is headed off in the future in the second year of operation. So well done. Thank you very much. And we'll now move on to introduce our next speakers. Thank you very much, Mark.
Thank you, Ian. Thank you, Alistair.
Danica, if I could ask you to put up the second, yep, perfect, okay. Our second speaker, probably one of the busiest guys, reading your resume, one of the busiest guys I know. He's a faculty member at the City University of New York. He also teaches at Fairleigh Dickinson University, the Fashion Institute of Technology, and also involved with professional career services, as well as Triana Group Inc., a Wall Street firm. Stephen is president of Disher Communications and Crisis Management Consultants. He has a master's degree in communications from Duquesne University in Pittsburgh and a bachelor's degree in journalism from the West Virginia University. He's done extensive consultancy work in media and speaker training and communications, corporate leadership, mergers and acquisitions, crisis mitigation, reputation management, sensitive litigation messaging, marketing, media relations, and public affairs. He provides audiences with lessons that interconnect decades of business experience with enthusiasm for delivering meaning when it comes to the trends and challenges facing business and society today. He leads a very very busy life. I don't know that he sleeps at night. Stephen is going to walk through. You have slides at your end, Stephen. I think you're going to post. And I know Stephen actually has to leave us a little bit early today, just before 3, because of course he's teaching again. So one of the busiest guys I know. So Steve, I'll throw it over to you, and we're going to talk about contract language and reflecting on the lessons of 9/11 litigation.
Well, thanks
over to you.
Thanks very much for the introduction, Ian. First, let me say that this is a very busy fall, and I'm actually fortunate that some of my overseas work has actually been done remotely thanks to COVID, and have done a lot of crisis seminars. I always say to people before I begin speaking that for some reason I've either been in the wrong place at the right time or the right place at the wrong time, however you want to look at it. But that was the case certainly back in September 11th when I was at Swiss Re. And I was recently speaking with an individual you know very well, Glenn McGillivray, with the Catastrophic Loss Reduction Institute for Catastrophic Loss Reduction. and Glenn is on the line now. And Glenn was a colleague of mine back then at Swiss Re. And I was there about 1 year and 9 months, and came across something that was extremely complex and hard to deal with. And I think that the theme here should be that the COVID litigation, particularly in loss interruption, but in certainly many other areas as well, is going to be very complex and difficult. So it's a bit of a warning to those of you that have to deal with this, that your reputation is going to be under fire. And this was the company that I was the chief spokesman for on September 10th, 2001. We just announced nice results of 1.3 billion. We had just been acquiring Lincoln Financial Group. The company was in a growth phase. We were integrating Conning, which was an insurance and analyst firm out of Connecticut. We were working on some administrative reinsurance acquisitions, as you can see there. And one of the statements in our news release is that the worst of the reinsurance industry's downturn is over and that recovery has begun. Insurance Day, the stock price was at 153 Swiss francs. It has never recovered because of many reasons, but not in the least of which was the next day. So I was based in my office in New York City on the 52nd floor of a Park Avenue Plaza building when the first building was hit at 8:48 a.m., which some people thought was a small plane had crashed into the towers. I remember my wife called me. I had my new hire out of London in for a week of training. And I had said that we were going down to the Wall Street Journal. And she said, you might not want to go down there. I heard of a small plane hit. And by the time we got our TVs turned on and got action, we saw the second plane hit live and knew that there was something huge here. So I want to talk a little bit about, now I'm not a lawyer, I'm a public relations guy. And to me, reputation management is everything. And a lot of things you don't comment on. You may have heard the saying, as a matter of corporate policy, we don't comment on rumors or speculation. This is often when you're dealing with M&A. And yet, when somebody calls you and they think you're making a $5 billion deal and you make a $500 million deal, you'll often guide them in another direction and break that rule. As a matter of corporate policy, we don't comment on personnel matters. This is always the case when you have a crisis scandal or something with an individual or somebody's let go. But I had an incident where there was a horrible tragedy involving one of our executives and his daughter, and we expressed sympathy for the family and commented there. So we don't comment on labor negotiations. Well, early in my career, I was with the natural gas industry, and the labor negotiations got nasty. In fact, the union had a fire truck show up with Santa Claus bringing coal to the company. So I went out and spoke to the news media then and revealed what we were paying the union members and offering them, and it helped to end that strike. But this is the one that's really the sticking point here. As a matter of corporate policy, we don't comment on matters in litigation. And yet, in certain situations, you need to comment on litigation. And the first question you need to know is why you're litigating, and you need to prepare your public relations for the public opinion part of this, along with your litigation. Your lawyers and your communications team and your leadership have to be in sync. You have to have some initial communications within the company, notifications that might be required to certain people, retain counsel, and then the preliminary litigation considerations. One of the most important things I found that we did early on was establish a small team that was given full, I wouldn't say carte blanche, but almost carte blanche on what to do. And that was the chairman of the Swiss Re America Holding Company, Jacques Dubois, my general counsel at the time, Marcus Deaton, who's currently general counsel with UBS, and myself as head of the public relations team. So getting that group together and establishing that we were the key communicators was essential. And then there's obviously the issue of collecting electronic evidence. We suddenly found that everything that had been communicated about Larry Silverstein's acquisition of the World Trade Center from the Port Authority of New York and New Jersey early in the spring. There were discussions and it was agreed in July. But the issue, ladies and gentlemen, was that we were in between agreement and binder and then contract. And various companies were at various stages. And so there was no precise decision on a lot of things. And yet Swiss Re on the 12th, I put out this news release talking about the tragic events and expressing the Swiss company and its people and all of its employees' sympathy for the United States. I was being asked all day about the financial loss. And one of the key things, if you can read it there, and I'll need my little glasses to read it, is the only thing we said that we have many times in our history faced with the consequences of large catastrophes. And even though this is one of the largest events, our financial strength is not in doubt. And it'll take some time to accurately provide information. So the main support was that we were moved by the tragic accidents, and our first concern was for the victims. On the other side of this issue was a meeting being held by the lawyers for Silverstein, Wachtell Lipton, their public relations representative, Howard Rubenstein, and some meeting notes where they were considering whether the World Trade Center is no longer a prime piece of real estate. It's a national symbol and it will become a rallying cry, such as Pearl Harbor. And so they said we must coordinate what we do with the city. What we say today is far more important than what we do in 6 months. Our comments will become instant headline news. Our language must be carefully weighed. It's not hyperbole to suggest that Larry Silverstein, what he says and does in the next several days will become American history. It seemed to me that the concern that they had was quite different from ours. And I won't go on any further to speculate on what was going on there. Sort of the facts. In 2001, in the spring, Silverstein Properties acquired a 99-year lease over the World Trade Center owned by the Port Authority of New York and New Jersey. And the land beneath it was still owned by the Port Authority of New York and New Jersey. The World Trade Center was insured as one structure. It had 2 towers connected underneath by a huge mall that was part of the World Trade Center. It had one energy system for it, and it was totally integrated. So it was insured as the World Trade Center. And by the way, raise your hand if you want to ask any questions about this. Silverstein had retained Willis as its insurance broker, and Willis was proffering a form with a multi-layer form of an underwriting submission known as the Will-Prop form. And it contained a definition of occurrence and provided for a total cost of $3.5 billion on a per occurrence basis. That occurrence language, I can tell you if I remember it from the case, because I must have heard it 1,000 times, was any series of events, similar or same events occurring within a 72-hour period shall be considered one event. The events happened within 15 minutes of each other. The other events in Pennsylvania, the Pentagon, happened also around the same time. It was referred to as one coordinated attack, eventually by Al-Qaeda, and that was led into the language. Now, the interesting thing is the World Trade Center was worth a lot more than $3.5 billion. It was underinsured from the start, and many people, including Warren Buffett, said nobody could ever have pictured anticipated such a catastrophic, complete loss. So this language on occurrence was important. And prior to September 11th, some of the insurers had bound coverage on an interim basis on the Will-Prop form, while others had bound coverage with their own property form. And later it was discussed that some might be on the traveler's form. So we were updating events on the tragedy. We were making estimates then about the potential loss, about $2 billion for us. And so we had ongoing media relations. And the point being is that we wanted to keep the public informed about what we were doing as the largest insurer of the World Trade Center. We had nearly 25% of the total coverage, many different layers, including excess layers, but up and down the insurance we had covered. So we came out with a statement there on the 20th of September, finally giving an initial loss estimate and assuring clients, very important to all of you and all of your customers and all of our customers who might be facing other losses, that we had the money to pay this loss and continue paying others. I think that's important. And it reminds me of the 08-09 financial collapse. Later, I used this lesson that we had the wherewithal to pay in the 08-09 financial collapse when people would ask about, can insurance cover it? And we certainly had an exposure at AIG and others. And I said to people, and they were concerned about the banks, I said to people, do you put your ATM card and the money still comes out? If your house burns down, AIG is still going to pay the loss. And if you have a loss of life, Swiss Re, the largest life insurer at the time, would pay for the loss of life. So getting back to business and getting people to understand that we were more than just this litigation was important, and we had to solidify our relationships as well with the media. Fortunately, I had worked for Mellon Bank for many years before I went to Swiss Re, and had always been building relationships with the news media, and that's essential in a situation like this because public opinion matters, and where the public opinion gathers strength from is the reading the third-party coverage. So as I mentioned, we had a legal team, a communications team, and we also kept in touch with Washington, where we had our government affairs team. Obviously, legislators and regulators were very concerned about this and getting the World Trade Center rebuilt, paying for the losses. And we had to make sure that we were all coordinated in sending consistent messages. I don't know if there's a hand up, but let me know.
Yeah, I don't see yet, Stephen, but I'm watching. Thanks.
Thank you. So then there was the suit against Silverstein Properties, which was really not a suit at this time. It was a request for declarative judgment, because Silverstein was saying that this was 2 occurrences already, and we wanted to make sure that we were directing payments to the right parties, and we wanted it to be ensured that we were able to cover all valid claims, and those included Silverstein's own claims. This is the federal courthouse in the Southern District of Manhattan. It is somewhere where a lot of important events take place. But the important thing here is we're talking about a Swiss company getting involved in a litigation dispute over an extremely sensitive matter in New York. And the complexities of that from a reputation standpoint did not escape myself or our leadership. And I think there's similarities with COVID in that this is a very sensitive personal issue. We've had a lot of death, and we've had a lot of changes in our lives and our lifestyles and how we can interact. And so there's a tremendous sensitivity there too. But that was the card we were dealt. And as you can see on the left side, there's a Bloomberg article where Larry Silverstein, who had leased the building, was seeking double payment and made this very public, that he wanted 2 payments because it took 2 airliners to strike the 110-story building, and that he should get twice his payment. What we saw and our colleagues in the insurance industry were concerned about, with Swiss Re as the lead insurer, is a possibility that if this became a case, a car hit by 2 vehicles in a parking lot and damaged beyond repair is required 2 payments, and thus 2 brand new cars. Or if the building had been hit by 4 planes, or if it hit by 10 missiles, how much would he get paid? Precedence to us was everything. This wasn't about Swiss Re's ability to pay. We made it clear that if it became a two occurrence, we would be able to pay that. But the point was that we were willing to pay. And in fact, we began making payments to Silverstein to cover the business loss interruption that he was facing. So we were making payments, and we were also filing for the declaratory relief. It's very important to make sure that people understood that Silverstein was getting full coverage for the rent that he was owed, even though the buildings were flattened, and that was the insurance companies paying what was due. Important quote from after we put out that news release was from Jack Dubois. He served as our spokesman. We're seeking a judgment consistent with Swiss Re's firm belief that the terrorist attacks constitute one insured loss. When I say spokesman, Jack had the statesman role. I had the role of taking on all the negative issues, which is the job of the public relations person. And we also had Mr. Marcus Dietelm, our chief legal counsel, who was dealing with the ongoing, more litigious items and the items that, quite frankly, were beyond my understanding. So these were the positions that were being considered by the Silverstein team. Howard Rubenstein, a well-known public relations practitioner, would have been on the other side of this from myself and the other insurance public relations people. And they were weighing again, the WTC will be rebuilt. And then would it be rebuilt in partnership with the people of America? Or would it not be rebuilt? It just seems that while we were willing and eager to pay and have the rebuilding continue, and the policy was such that we would pay as a pay-as-you-go basis, and that was the nature of the policy. So it's very important that we sought this ruling. We wanted to move the payment forward and then move the rebuilding forward. But Silverstein was standing strong. These were lead articles on the left, Wall Street Journal, and on the right, Stephen Leviton. Both these individuals I knew from my Mellon Bank days. They'd covered a lot of mergers and acquisitions. And I think they did a fair job throughout the case. But the coverage ran all over the place. Every time we put out a statement, when we advanced a claims payment, we would announce it. Normally, we don't do that. And the point here was to make sure that the world understood that Swiss Re was not declining to pay, but in fact, Swiss Re, which had been the first insurance company to agree in 1906 to pay for losses in the San Francisco earthquake with the concept of fire following. And we wanted to maintain our good reputation. So on it went. We're into November already. And I think you'll notice as these dates go on that things start to happen, and yet some things never happen. Fascinating to me as a non-attorney and certainly not an insurance underwriter. I was in public relations in the utility business. My background is in journalism and the master's in communications. I did study some business with INSEAD in France, but my understanding got confused when I found out that Silverstein agreed to one occurrence with two companies. And it was a very simple question to me was, well, how could it be both? And obviously insurance language and insurance disputes are very complicated. But as you can imagine, we had a lot of people wondering, well, the same thing. How can you agree that it will take one occurrence from two that already had some language established, but it would continue on whether it was two occurrences because of the finite and very particular language of occurrence and how clear it was, and also whether the companies were actually on will prop or not. I'll make it clear again, but just to understand that this one versus two thing was an oversimplification of our case, the Lloyd Syndicate cases, and a number of other insurers that were involved in the litigation, because it was really about the first litigation was, were you on will prop or not? Because Judge Martin had declared that if you were on will prop, or it may have been the next judge, we had several judges, Mukasey actually came in who later became the Attorney General, made it clear that if you were on will prop, that it was one occurrence. So we worked a lot, myself, the chief lawyer, and the Mr. Jack Dubois, the holding company chairman, would hold editorial board meetings to try to educate people. And Holman Jenkins, a very influential member of the Wall Street Journal staff, ended up writing this op-ed called The Importance of Being Larry. And I would invite you to read this. Take a moment. I find it interesting that he references that Silverstein is a New York City real estate developer, a species symbolized fairly or unfairly in the world's mind by Donald Trump. So take that for what it's worth. But this was certainly a powerful statement about Swiss Re has been the world's biggest large loss insurer, practically forever. It bore the lion's share of claims arising from the 1906 earthquake. Its global reputation depends on being prompt and honest in paying legitimate claims. To me, that was such a strong message in that article and meant that our message was getting through at the highest level of the media. Further on, Stephen Brill, who was a very talented reporter in Newsweek magazine, had a very similar type of lines referring to the heroism and sacrifice of 9/11 stories, but this is not one of them, and saying that what's certain is that anything beyond the $3.55 billion one occurrence limit that Silverstein gets to settle his loser case, this is Stephen Brill, will be worth the millions he's paid for scorched earth legal and PR warriors. After all, just 5% means 177 million. Litigating has clearly been Silverstein's best ground zero investment. These types of stories we then shared with legislators and regulators, people that were trying to determine exactly what was going on here and how long it would take to get the payment made. We're almost a year later, and the court says the trial will commence November 2002. Remember that date. So Swiss Re Chief expects dispute will go to trial. There was no settlement that failed, and we started to produce things like actual cash value and other options that Silverstein could accept rather than wait for the money to be paid out to take early payment of money. You're all familiar with the time cost of money, and we could have settled. Another summary judgment was made that it was one occurrence for Royal, Hartford, and St. Paul. So now we have at least 5 insurers that have been settled on one occurrence. So things were not going the Silverstein way. Now we're into December of 2002, and you can see that November date for the trial to begin had passed. There were just appeal after appeal after appeal. And the only thing I have to say is that along with myself, my deputy, Mike McNamara, who did a great job working on this case with me in media relations, and the others that were involved day to day, we were still running a public relations department doing employee communications, marketing, and all sorts of things at the same time. And this was just a learning process for me. I dealt with litigation at Mellon Bank when I was the head of corporate communications there, but not something that went on and on for years. And there were filings almost daily. They're released several a week. And the stories continue. They're growing overseas. They're growing into other publications, and the coverage is getting very heavy. So we had to appealing briefs and details of Silverstein's case. You can see our language was very non-Swiss. We called appeals brief details of Silverstein's concocted case to cover his error of underinsuring the World Trade Center complex for a maximum payout of $3.5 billion. This type of language and being rather forceful was a change of pace from when I joined the company in 2003, because Swiss Re was considered sort of the quiet AAA that paid its claims on time, but here was a difficult situation. Evidence confirms Silverstein's 2 occurrence claim is a self-motivated hoax. there was a lot of evidence and disclosure that was beginning to reveal that Silverstein and some of his people, particularly his chief risk officer, were concerned about the case and had written notes on the day of the accident to that effect. So Judge Michael B. Mukasey, who many of you may be familiar with, was reappointed. There was more appeals on those summary judgments for Royals, Hartford, and St. Paul. They were rejected as frivolous and counterintuitive. So he's losing some more. But look where we are now, June to September of 2003, 2 years later. In October, Silverstein asked to rehear the case. He informed the district attorney he's ready to present his case, or we did, and the district court ordered the trial to proceed in 3 phases. This was the phase 1, where it would be decided whether or not you're on the Willis property form. We used every avenue possible, particularly when Silverstein would speak out to the news with something we thought was false. We would publish a letter to the editor. And the key thing there is to be fast when news comes out. And today you have to be faster. I mean, this is not pre-social media, but pre the incredible plethora of social media. So going to the Wall Street Journal, making sure that we took on, as it says, Mr. Silverstein's audacious claim to recover twice for the destruction of one insured property and how it had been rejected by the courts in so many cases. These things were written and edited by myself and Jack Dubois and the chief legal counsel to make sure that we were all in enjoyment. There also our outside counsel, Barry Ostrager, now I believe a judge who was with Simpson Thatcher, was also the outside lead in our case. Did an excellent job. We finally come to December of 2003, and the trial date of September 9th is announced. We're finally set to begin the trial date, and this time it fits. You might notice below that these appeals kept getting rejected. There's a picture here of just a couple of my files drawers that were filled with the litigation. Every filing, every day in court was highlighted, notated by myself and 2 members of my team. Here's the issue. The judge had put an order to not speak about each other's companies in place, so-called gag order. But we were allowed to explain what happened in court. So what we used to communicate with the media and to make our messages known and write our news releases was citing transcripts and legal clarifications that happened in court and using exhibits. And that was critically important. It's interesting, if you note this Wall Street Journal article, insurance notes entered in the World Trade Center. Bob, I believe, worked for Silverstein as his chief risk officer, or somebody there in the firm said, occurrence definition in the insuring agreement and the exclusions in the Willis property that we are working with. Notes, I was surprised. There were Post-it notes and things that all came into play. So this is the stage where it's about 1 versus 2, and not 1 versus 2, whether we were on WillProp or not, because it was ruled that if you're on the Willis property form that had that definition of occurrence, then the case was over, and it's a 1 payment. And as I noted, jottings may cut insurers' payouts on Twin Towers. I don't want to read for you the article, but there were things, people saying, end of the world, we can't win, things like that. Reporters changed over time. That was a challenge, not only with the Wall Street Journal and New York Times, but with the Swiss papers and the German papers and the London papers, because it was taking so long that reporters would change beats and all that. And Dean Starkman took over at the Wall Street Journal. Dean is a Pulitzer Prize winning reporter, and Charles Bagley was well versed in insurance. And we worked very closely to make sure that they knew everything that was going on, and they got the filings as quickly as we got them. Everything was public, and we eventually were able to electronically get them the filings, get them the things as quickly as we could. So February 9th rolls around. I don't want to, I just want to impress upon you that public relations departments can be under such stress. On February 8th, we had a litigation in Tennessee where we had an outrageous judge settlement that we had to pay something like $800 million for a litigation over a $50,000 life insurance suit. Obviously, that was later mitigated. But I also announced an acquisition on 1:30 a.m. that night because it was we would always announce acquisitions and major issues at 1:30 a.m., which was 7:30 a.m. Swiss time, before the markets opened in Switzerland and on the virtual exchange in London. At the time, we were not traded actively on the New York Stock Exchange. We were traded through other underwriters, not underwriters, rather investors. So now we get into February. The case is ongoing, and you can see Stephen Brill. The reason all should care about this is that at the end of the day, what happens, he's going to lose the case. There's no chance, etc. Stephen Brill also was a lawyer. National Underwriter, obviously very focused on it because of the precedent issue. These are just examples of papers in other languages, other publications. This idea, will jury sympathy be a factor in the World Trade Center trial? That's an important point. This was taking place in the Southern District of Manhattan. These were New York City jurors. So, and here's kind of a sad point, that with all this litigation going on, that 1.3 billion had already been paid out to Silverstein and had been spent basically covering the rent. Now, I have mentioned that we were under a gag order, and Larry Silverstein was topping out one of the other buildings, 7 World Trade Center. They had a topping out ceremony, and he stood in front of an American flag and made a comment that I would call derogatory towards the Swiss, and that we were unwilling to pay. And so I was called for a comment, and it said, when asked to respond to Silverstein comments, a spokesman for Swiss Re, the lead insurance company in the case, noted the instructions of Judge Mukasey, and I said, the judge instructed the parties in the case not to talk to the media during the trial. And again, and I said, we will honor that request. We did talk and clarify things that were filed in the litigation, but there was nothing said about either company. So Silverstein had said this, and in my commenting, it came up that he defied the judge, and Silverstein, who had been sitting in the courtroom every day, was blocked from attending the courtroom because of his statements. And that was obviously an interesting activity. I was subpoenaed, but the subpoena was quashed because I had done nothing wrong other than make a very straightforward comment. Here we are into March 26th. This trial has been going on since February, day after day, testimony, intense testimony. I pull out a couple of quotes there. 7 weeks into a trial with the insurers, Mr. Silverstein finds himself in an uphill struggle to get the money. Mr. Ostrager pounded a one witness on Silverstein's side for 5 full days. Well, in the end, there was a verdict. But guess what? I had planned all the communications on whether Swiss Re won. I also had planned all the communications, both the news release, the Q&A, our message to employees, our messages we were going to give to regulators about if we lost, which was about an appeal. And I always say that preparation is key for a corporate communications person. I didn't anticipate a hung jury. The decision was made on that Royal, Zurich, and Twin City, and also the Lloyd syndicates. The Lloyd syndicates were on, and all of the others were on, but not on Will Prop were these others that would go to phase 2. but we had to wait until the following Monday, May 3rd at 5:05 p.m. for Swiss Re, for the jury to rule in our favor, and that we were also on the will prop form. I want to point out that there was no bloating done, no bloviating and bragging or chest thumping about the verdict. We simply said Swiss Re issues statement on jury verdict. Swiss Re today issued the following statement. It's very straightforward. He said, we are grateful for the jury's full consideration and attention throughout this trial. It was a very sensitive matter still. To me, I think, personally, having been involved in this, the emergency on day one, where we had to look and find our employees, many of whom often worked with companies that were based in the towers, many who flew every day, from that day through the litigation, had never really given it the amount of consideration that it was worth. And a lot of us that were involved in it, I think, felt a tremendous relief of pressure, but also the fact that we could finally kind of look back on what had happened. So the following day, you could see some of the headlines. Larry loses again, New York Post. The German Wirtschafts that says World Trade Center Swiss Re wins the process. The jury limits the payout. There was news stories in the Zürcher Zeitung, which was the Zurich paper, very important to my colleagues who worked in Switzerland. The FT, we had a major building in London, and a major operation there as well. So getting that kind of coverage was key. As things wrapped up, there were op-eds afterwards that were sort of positive that now that this is over, things can move ahead. And we hope they did. But as you know, it took many years to wrap up. So a lot of media coverage, a lot of activity, a lot of pressure and fine tuning and you know, really measuring between words. But in the end, I think that the outcome was right, and it was just, and it was good to be over, quite frankly. And that concludes my presentation.
Do we have questions from our viewers out there for Stephen?
Right, thank you.
Regarding the presentation. It's kind of the story behind the story, and it shows the importance of contract language back then and now with COVID-19 and business interruption that was old as new again. So I think
yeah.
I see a hand here. So Narani, can I ask you to unmute yourself and ask the question, please?
Hi, Stephen.
Hi.
My question is around the your last slide there when you said not will prop for Royal Zurich and Twin City. Does that mean that theirs was considered as too?
No, they had to go on to another phase, and in that second phase, only 8 of the 9 phase 2 insurers appealed. 3 of the 8 insurers were bound by forms with no definition of occurrence, and they ended up, I believe, paying double. So yeah, there were some that went on to the third phase. There were some that never entered phase 1 because they were either on Travelers or they believed they were on their own form, and we're not arguing to be on will prop. It's a good question.
And let's jump to Tracy Mann. Tracy, can you please unmute yourself and ask your question? Thank you.
Stephen, thank you for that. That was very interesting. Kind of get to see behind the curtain of a world event.
That's great. Thank you.
Clearly, the Swiss Re leadership would have kind of a different cultural perspective on dealing with this than maybe the American stakeholders in this. So did you have any challenges in kind of setting a communication plan that would meet both the needs? And if so, how did you deal with that in the situation?
Thank you very much. Yeah, that was very important. The Swiss culture was not accustomed to being so open and vocal, and in fact, using some of the language that I had. We made it clear that in our employee messages, but anything could be read publicly, that we were fighting a case, and it was an important case from a precedent standpoint. We kept employees informed. We had a separate site on our website, intranet, where you could see everything that was happening, the stories being published, the articles being published. So we kept them informed. But I'll be quite honest with you, we were pleased that the business kept running and the business kept going. And eventually it really was just us, a team of lawyers at Simpson Thatcher, our chief lawyer and his team, our chairman, and my team dealing with this and letting others go about their business. And fortunately, I had a good team of, I don't recall at the time, number of communicators around the world that were active doing marketing. People like Glenn McGilvery on this site, who was responsible for our public relations and marketing in Canada. Thanks for the question.
If there are no other questions, do we have any others? I know Steve's got to run to his next gig. Class starts in probably 10 minutes. So
I'm very busy, but if anybody needs help on PR with COVID, let our communications know and we'll get on it. I think
Absolutely.
it's going to be an interesting ride and complicated as well, particularly as we see a second wave coming, and the idea that on the first wave, people may not have known what to do, but on the second wave, things may change the perception of how it's being handled. So I think it'll be as complex, perhaps, as our case was.
great.
Thank you for the opportunity, and it's a pleasure to be with this great group.
Thanks so much, Steve. Contact information will go out with your slides to all members, so you may hear from someone. Thanks very much for being here today. Really appreciate your time.
Thank you, Ian.
Okay, thanks so much,
Bye.
and take care. Now, if I could ask Danica, could you go back to the PACICC slides and put up the next slide? Perfect, awesome. So I'm going to introduce our next speaker. We're a little bit early. I know Paul's still on the line, so let's get right to it, and perhaps we can shave some time off the end of the day for everybody. It's been a long session, but it's a very informative session. So Paul Rand is Chief Information Officer with Omni Bridgeway Canada. He has a great deal of experience in the legal profession. He's a litigator, transactional lawyer, has had senior roles in private practice and in-house counsel. At Omni Bridgeway, he's focused on disciplined risk management with a mandate to help clients apply innovative financing to litigation assets. He works with law firms seeking to accelerate profitability with a funding partner. Paul was a member of the capital markets team at Blake Castles and Graydon LLP. He held in-house counsel positions with Royal Bank of Canada. He was counsel managing a litigation portfolio and later a senior counsel advising on complex transactional and regulatory matters. Paul began his career with the litigation group of a firm now well known as Norton Rose Fulbright Canada. He's been repeatedly recommended in the Canadian Legal Expert Directory, in connection with derivatives instruments. He's co-authored The Law of Fraud in Canada and served on the board of the Association of Corporate Counsels Ontario Chapter. He has a law degree from the University of Western Ontario and a bachelor's degree from Queen's University. We like to provide inside looks at provocative subject matter with the Risk Officers Forum, and the funding of litigation possibly against insurance companies certainly fits that bill. We've had disruptors in the past. We've looked at on-demand insurance, and we thought this would be a very thought-provoking presentation. So if we could drop that slide, Danica, thank you, and post Paul's slides. And then I'm going to ask Paul to unmute himself and turn on his camera, and I can then pass things off to Paul.
Hi, Ian. Can you see me?
I can't see you. I can hear you. And I say, oh, yes, absolutely, at the bottom of the screen. Sure. And we have your slides up. So I will hand it off to you. Welcome, Paul, and thanks for being here.
Yes, fantastic. Thank you very much. I appreciate the introduction. I, of course, sit up a little straighter when I'm introduced in the context of being provocative, not something that is necessarily my go-to, my default. But I am indeed thrilled to be part of this discussion. Third-party funding is fascinating from my perspective, and I think from all of the conversations that I have with folks, it seems to be a more broadly held point of view. So it's a topic that I love to talk about. The second reason that I'm delighted to be part of this discussion goes back to when Ian and I were first having a conversation about this forum, and he described the purpose, he described the attendees, and what struck me was that a major part of these get-togethers is to look at interesting developments, to delve into an understanding of things which might prove to be important to your industry, and just generally a level of curiosity. And that's something that I respect. And so I'm pleased for that reason. And the third reason, of course, is it's given me an excuse to put on a suit, although evidently not get a haircut, which you can see. So my apologies for that. The timing is, and I mean the time of day, is really one of those COVID features. It's back from school time, and so my four boys will be piling into the house soon. Apologies right off the bat for any dog barking or similar background excitement. So this is really intended to be a discussion. I will work through the slides, and Danica, I don't know if I should maybe take over with my own slide deck. We can give that a try. I'm used to Zoom and not.
So I think then, Paul, if you use the on your taskbar there, you will see the. I think you can take control. The it looks like a square with an arrow going in. Yes, then I think you've got control of the slide deck now.
Okay, fantastic. Interestingly, I can't see it. Why don't we go back to you then being in charge, and I'll stop sharing. All I wanted to say was that this is intended to be really a discussion, and so I invite questions throughout. I have reserved time at the end, and so the idea is that if you want to hold off until the end, that's fine, but please don't for a moment be hesitant to dive right in. So Ian's very kindly given you a bit of a sense of my background. If you spend a little bit of time thinking about the different areas of law that I've practiced in, it might strike you that it's a bit of a smattering, a bit of a mishmash. And really until about 2.5 years ago, when I joined Omni Bridgeway, I would have probably been inclined to reflect on my experience to date and sort of shrug and think, what sense does it make? A one-time litigator who's now practicing transactional capital markets work. I found myself on a chairlift at Beaver Valley Ski Hill beside a friend of mine who's a very successful litigator and a fellow who spends a lot of time in the international arbitration space, where litigation funding is and has for a long time been prevalent. And he said to me, there's this organization, they're in Canada now, they're looking for talent, you might fit the bill. Of course, I jumped at the opportunity to look into litigation funding. But the reason I mention any of this is because my first reaction, my gut reaction, was probably similar to the thoughts that someone on the call may be having, which is, well, is that even legal? Is that something that's done? And so I spent a good amount of time getting familiar with the evolution of third-party funding outside of Canada and in Canada. But the fact of the matter is that Omni Bridgeway has in many ways been leading the charge in terms of developing the third-party funding litigation market in Canada. And the same is true globally, where the company has been active in this market for over 30 years. And if we could just go to the agenda, which is on the next slide. The roadmap today will be to talk about the what is and what isn't litigation funding. We'll set a baseline common understanding. And then I propose to move into an overview of how Omni Bridgeway goes about making its investments and its decisions in respect of cases. And then third, and this is of course somewhat tongue-in-cheek, I propose to talk about why it is that everyone can come to love litigation finance. And while I do mean it somewhat tongue-in-cheek, there is certainly a genuine sense and a genuine belief that as a risk management tool, litigation funding is agnostic as to what type of organizations can benefit from it. So I offer that as a little bit of foreshadowing of my thesis or position on litigation funding, and we'll certainly welcome the opportunity to hear questions and other views as we get further in, and then to the end of the presentation onto questions that might have built up. So then next slide is just a placeholder, and I've inserted these. What I propose to do is pause when we get to these different acts of the presentation, and I'll take a breath and I'll let any questions bubble up that may have emerged. But let's go on then to the question of what is litigation funding. You'll see here that I've drawn a distinction between categories of consumer and commercial litigation funding. Consumer litigation funding will not surprise you to hear is the nature of funding that focuses really on personal injury matters, generally funding smaller claims and on, as I said, focused on the personal injury side of litigation. That is not the area of litigation finance that my company is involved in. I won't be speaking really in any great detail about consumer side litigation funding, so apologies to those in the session who have a particular interest in that. Rather, our focus is on really the high-end, large-scale commercial litigation disputes. And you'll see there that I point out that it's non-recourse, that it's funding of companies, individuals, or law firms, and that, of course, the outcome or the result to the funder on a successful investment is participation in a share of the outcome of a commercial case. The next slide just expands upon some of those comments, but I highlight there, and forgive me if this is really too obvious, but the investment that comes from a litigation funder is to support the costs associated with a claim. And there's no hard and fast rule as to what might or might not be covered in an investment or by an investment by Omni Bridgeway. But generally speaking, it will cover legal fees, costs of disbursements, expert costs, and so on, as well as security for cost issues, and in our case, in most instances, the risk of adverse cost orders against the claimant. There's just a point there that our return is, again, funded on or provided for on a non-recourse basis. We only turn to the proceeds of the actual litigation to receive a return of our capital and our anticipated return. The question of the anticipated return is always one that's, I think, in the forefront of a person's mind as soon as they arrive at an understanding of the basics as to what litigation funding is. You figure out what it is in broad strokes, and then you find yourself curious, okay, well, what does an investment look like? The returns are, as I've indicated there, determined based on a percentage of the proceeds of a piece of litigation, or in other instances, based on a multiple of the amount of capital invested. or, as is increasingly the case with our structures, a combination of the two, meaning the greater of a percentage outcome or a multiple on our invested capital. So I in the third bullet, I flag that the scale or scope of a return is dictated and influenced by a variety of factors. And that should, I think, be intuitive. The anticipated length of time that a case will take, the amount of the investment required, the likely nature or size of the recovery, a range of other possible risk factors will influence the return and the return structure that might be agreed by the parties. And indeed, in our practice, the investments that we undertake really are quite bespoke and particular to the cases in issue. And so you'll perhaps be understanding it when I'm reluctant to tell you what the cost of an investment or of a litigation funding transaction might be. But at the same time, I don't want you to think that I'm being evasive. So let me give broad brush indication or broad brush strokes as to what types of return funders will commonly expect. And I think it's best to look at them in comparison to what a lawyer's contingency arrangement might be if they were to take a case on full contingent agreement. And so therefore, investor returns are generally in the neighborhood of 30% of the proceeds of a claim. Or if it's a multiple on invested capital, it might be a 3 or a 4x of the invested capital. But of course, subject to it being considerably more and in some circumstances less. So the next slide gets into what we are not, we litigation funders. We do not provide loans, at least in our approach to the business. Our funding is in the form of a non-recourse investment. We will not turn to a claimant and seek recovery from their own assets in the event that a litigation that we choose to fund is unsuccessful. We're not insurance, and that, of course, will be interesting and relevant to this group in particular. It's an issue that we've considered carefully and spoken with a number of lawyers. Shout outs to Walker Sorensen, I think, who are represented on the call, and regulators. And so we have comfort that as we approach our investments, we don't act in an insurance capacity. And third, we're not a counsel relationship. We are all, as it turns out, lawyers in the Canadian business of Omni Bridgeway, but we don't act as lawyers to clients. We will sometimes, as we describe to clients, serve as a strategic sounding board where questions can be put to us, ideas, a second set of eyes provided. So we do have the ability to augment the bench strength of a claimant, but we really don't act in a law firm capacity. Okay, the next slide gets into another point that's helpful for understanding what litigation funding is, and that is to address what type of claims are suitable for our type of litigation funding. You'll see that I've given a little right-hand footnote to say that we're not targeted or particularly focused on a type of cause of action, nor do we have a specific industry or set of industries that we think are particularly necessarily the appropriate domain for litigation funding. Rather, we look at commercial claims and we make a determination as to whether they're meritorious, whether they meet with a very rigorous review process, and whether ultimately we conclude that they're going to be successful. And that's successful as cases, but of course also successful as investments in that we don't fund cases where the prospects of recovery are remote or unlikely. So that is just to say that we do look at really anything that a claimant might seek funding for. And down the left-hand side of the slide, I've set out a number of the areas where we've got investments or where we have in the past invested. Right off the top, breach of contract claims. Those are in many ways the plain vanilla optimal type of case for litigation funding, at least from our point of view. To the extent that a breach of contract claim is often heavily document driven, doesn't turn necessarily on a lot of individual evidence or testimony by witnesses. And therefore, it's a case that's often fairly easy to understand early on, which is critical, obviously, to us making a determination as to whether or not to make an investment. We, not long ago, I won't be more specific, resolved a case or an investment that we were supporting, which was fundamentally a breach of contract issue. And it was in many ways a very clear-cut case. And the presence of us as a funder at the table, I think, helped underscore that fact. And it helped reinforce perhaps a message to the other side of the dispute that any defense that was premised on a strategy of attrition would be met with a robust effort to advance the case. And so the case settled very early on, and the client was very pleased. And from our perspective, because of the timing, the IRR on the investment was in the many hundreds of percents. So we were satisfied with that. You'll see a range of other commercial disputes listed there, including oppression claims, complex business disputes. Domestic and international arbitrations is in the middle of the list, and that is, as I've already indicated, an area where litigation funding has long been an important part of the landscape. Construction litigation, competition law. Some of you on the call may be familiar with the packaged bread claim, where a class action alleging that there's been anti-competitive pricing behavior in the packaged bread markets. That's a matter that we're supporting and invested in. And then you'll see at the bottom insolvency-related claims. And this is an area where I'll pause just for a moment, because I think insolvency claims or claims in an insolvency context offer a really interesting microcosm for exploring a theme that I highlighted at the beginning, namely that litigation funding is a really potentially a valuable tool to claimants in a variety of different positions within the litigation environment. On the one hand, litigation funding in an insolvency context can support an insolvent party that has a claim that is a valuable asset, but that it doesn't have resources to pursue. And so any law nerds among us may be aware that at the beginning of the year, one of the cases that we're funding, Blueberry versus Calidus, was at the Supreme Court, and the Supreme Court found that our litigation funding arrangement was properly approved by the Court of First Instance. And so that litigation is charging ahead. And that's an example of the David and Goliath paradigm. And that's a very common scenario in how litigation funding can work. It's probably what many of you think of when you think about litigation funding. The under-resourced party being supported in a claim against a well-resourced defendant. That's one side of it. But there's another side or there are many other sides in the insolvency environment where litigation funding can be a useful tool. And just to point to one, there may be scenarios where creditors of an insolvent party or a party that's experiencing financial distress look at their debtor and determine that there is a valuable set of cases, claims in that company's ownership, or one claim for that matter. And the creditors may decide that despite the fact that there's value there, they're not interested in putting good money after bad, or they simply don't want to be caught up in the drama of funding and pursuing litigation with that debtor in an ongoing context. And so they might choose to partner with a funder who would be able to step in to provide, number one, an impartial case assessment, a take on the value of the asset in question, and then invest money to assist in seeing it through to fruition. And so that would result in, of course, a return to the debtor and up the chain to creditors. So all of that is to say that there are different sides to the opportunities that can emerge through litigation funding. And you'll hear me encouraging you, subtly or not so subtly, to perhaps review litigation funding strategies as a tool and not some existential threat or some ill to be very skeptical of. But we'll see when the questions start coming in as to whether I've been successful in that respect. So over to the next slide, please. You'll see that on the previous one, I didn't list class actions, although I did mention the bread class action. Class actions get their own slide. The fact of the matter is that for Omni Bridgeway in Canada, class actions are actually a fairly small part of our portfolio. It's not an area that we've focused on developing for a variety of reasons. It is an area where we will participate as a funder from time to time where the case is right or where the investment opportunity is right. But class actions have formed an important part of the third-party litigation funding story. And I think there are a couple of reasons for that. Number one, you and I are all potential class members in a variety of contexts. So it's something, class actions are something which, at least to some extent, resonate on a personal level. They're also, of course, a very big concern to companies in terms of exposure. And so they get a lot of attention as a consequence of that. And thirdly, and maybe a little bit less obviously, in the class action context, there's a requirement for parties who are providing funding and representative plaintiffs who are seeking funding to go before the court and obtain approval for the third-party funding arrangement. And the result of that is quite a bit of jurisprudence outlining what ought to and what ought not to be a part of third-party funding arrangements. The second bullet, I simply point out that a lot of that jurisprudence has also commented on the value that funding can provide in terms of sustaining access to justice for claimants, and that has itself filtered through other elements of third-party funding. And then finally, and this is in some way a throwaway point, but also I think one that is worth remembering, and it is that where there is a third-party funder involved that's reputable, like Omni Bridgeway, they will provide that reassurance to a defendant that in the context of class action, where an cost award is made against a representative plaintiff, that there will actually be pockets to answer for the costs associated with that litigation. So over to the next slide, I have asked the question here, why is litigation funding growing? I think you will all have seen the occasional headline as far as litigation funding's uptake in the Canadian market. It's been a reality in other parts of the world, frankly, for a number of decades. And it's probably not an exaggeration to say that it was the arrival of Omni Bridgeway 5 years ago almost in Canada with its own operations that has really driven the awareness of third-party funding within the legal community and within the corporate community in terms of a tool and a strategy for dealing with litigation. This slide, however, really it highlights somewhat the yin and the yang of the growth in litigation funding. Maybe that's not quite the way to characterize it, but on the left-hand side of the slide, you'll see there are some quotes from judges which underscore points that I think are well known to all of us on the call, namely that litigation itself can be massively expensive, a difficult project for many to decide to embark upon, and it can be an area where people find themselves being depleted of energy and resources through defenses that are frankly intended to delay, challenge, and obstruct. So part of the growth of litigation funding, I think, has been an interest and willingness by judges to recognize the opportunity that emerges in terms of promoting access to the courts as a recourse for addressing concerns and problems. And then on the right side of the slide, I've noted some of the more practical motivations, I suppose. The first one, it's a theme throughout. We're talking about money and litigation, and the reality is that it's an extremely expensive exercise. Nobody will be surprised, I think, if I were to say that we, as a starting point, expect an investment to be at least $1 million when we look at the prospect of funding a case, on the theory that it will be at least $1 million to provide a budget for an effective commercial litigator to take a matter from inception through to conclusion. And so the opportunity to find access capital to address those costs from another party has been, I think, very popular with many and is growing in popularity. I've already mentioned that coverage for adverse cost orders is also a related and important consideration. The third point there, budget stability, that's one which I think is of interest to sophisticated corporates. And those are entities that maybe will look at a piece of litigation or a portfolio and really place a premium on understanding what their costs and exposure will be over the time, the course of the litigation. And so when you have a third party who's paying, in some instances, 100% of those costs, well, you have absolute certainty that you will have zero exposure. As we'll talk about a little later in terms of the process, there's also the fact that we seek very rigorous and accommodating budgets from lawyers to understand their projections as to what a piece of litigation will cost. And so that helps early on setting expectations and understanding about a budget for a claim. The next bullet, funding companies' operating expenses. What I'm getting at there is that for some clients, there's an opportunity to partially monetize their litigation assets in a way that unlocks money for working capital. This may be applied really for anything, operating expenses of the company, or in more targeted strategies, it may be used by a legal department to take the value of the claims in their litigation portfolio and offset the costs of their defense activities. Last point there, strategic benefit. Really what that's getting at is the fact that, number one, as I've said, we do provide this sort of sounding board for our clients and their lawyers. And number two, I think there is a really compelling message to defendants when a third party has looked at a case very carefully and made a determination that there's a sensible investment opportunity, and indeed has put their own capital at risk with the prospect of a zero recovery if they've made a miscalculation in terms of their understanding for a case. So that, I think, does bring real value to the dynamic as between a claimant and a defendant. And maybe finally, just to reiterate a point that I've made, part of that strategic benefit is a signal to defense counsel that a strategy of attrition is unlikely to do anything other than enrich the defense counsel and plaintiff's counsel, because when a funder's involved and when a well-resourced defendant is involved, there's plenty of money to pour into the litigation, and that can have the effect of causing parties to think seriously about resolving matters in an effective way early on where possible. Okay, so that brings me to the end of Act 1. That is the introduction. I've already talked a little bit about approach and process, or I've touched upon a few elements. This part of the discussion, frankly, is a little bit more oriented towards conversations that we would have with clients, lawyers, law firms who want to know about what the exercise looks like when they approach a litigation funder. So that may have some direct relevance to you. It may be interesting insight for you to share with legal colleagues. But more than that, I think what it will offer is an understanding of what might inform a litigation funder's approach and strategy when making an investment. I will, for dramatic effect and the opportunity for someone to get a hand in, just pause for a breath.
Absolutely. Are there any questions out there? A point that I saw, Paul, in this, just the and you touched on it in your summary there, the right-hand column, that when your company gets involved in funding, it really is sending a message that this is a worthwhile investment. And have you seen situations that maybe would have been a little more dragged out, longer processes come to a quick conclusion that when they realize that it's not in their best interest to drag things out because you're not going anywhere? Is that
yeah, Ian, I think we locally, so within Canada, we're starting to see that. Certainly from a global perspective, my colleagues in other jurisdictions have observed that, with some regularity. It's not, it's definitely not 100% of the time, because regardless of how commercially minded litigants may be, there still is a degree of emotion that informs some litigation. And so regardless of what logic might be telling a defendant or a claimant, it doesn't always carry the day. But I do think that we've certainly seen it here in some to some degree, and as I said, it's not at all uncommon in other parts of the business, in other jurisdictions. What I maybe should mention, and I probably touch upon it in a slide later, but it is our practice in Canada to disclose our involvement in a litigation funding situation. As I already noted, that would be de facto the case in a class action funding, where the parties have to go to court and where a responding party has, a full opportunity to challenge the arrangement. But even in commercial disputes, where the relationship between a funder and a funded party is effectively a private contract, we nevertheless make it a practice to disclose our involvement, subject with the caveat that there have been, I can think of 2 instances where the funded client has expressed a preference that we don't share that for their own reasons, and because it's not a requirement but rather something which we think is helpful, we do it, but we don't do it if our funded claimant asks for that not to be done.
Okay, are there any other questions from our viewers out there before we move on?
So on to the process.
Okay.
The next slide, it's funny, I actually edited the heading here, our funding process. If you were sitting with a client in a pitch contest, you might see a slide that looks like this, that says, our easy 3-step process. And I had to change it because it's just, I think it's unreasonable for us to pretend that our process is easy. It is something which we try to do with our clients as efficiently as possible, but it is a very deliberate and a very careful assessment that we undertake. We've been told by a QC based out in Calgary a couple of years back that he found our process rigorous but not stupid, which was his effort to compliment us, I think. Or no, I'm sorry, annoyingly rigorous, pardon me, but not stupid. So we start with that initial opportunity assessment. It's a telephone call, generally speaking, a meeting in non-pandemic days, where we put in place a confidentiality agreement and then have a high-level discussion about the nature of a case. And that flows into a pretty slim term sheet, which we sign up on a non-binding basis in order that the parties understand the broad commercial arrangement that's contemplated. So once that's in place, we then move into what we call our deep dive due diligence. And in the deep dive part of things, we do both an internal review and we'll engage experts, whether they're legal experts on a specific issue, damages experts or others, to help us determine the strengths of a case. The due diligence exercise might be 30 days, 45 days. We really give a careful review of the case. And we've been told by lawyers with whom we work, claimant lawyers with whom we work, that they really appreciate the exercise, that while it is a bit of, it requires a strenuous assessment of a case, what it does is it uncovers early on warts and opportunities and strategic considerations in a case. So it promotes a real state of readiness for claimant counsel. And while I don't have the details listed in any of these slides, I've used a slide in the past that sets out all of the law firms with whom we've either funded cases or have received applications for clients. And you will recognize all of the names. The 7 sisters are all represented, as well as the 30 or so top national and boutique litigation practices across the country. So that's the due diligence process. Once we have a really solid understanding of the case, And that may include, I failed to mention, that may include talking with potential witnesses and understanding really the ins and outs of what a trial might look like in 2 years' time. We then put together our position and have the investment approved by our investment committee. And along with that, we'll enter into a funding agreement with our clients and begin the funding exercise. I make reference to the fact that we then will be monitoring the case along the way. I think it's probably fair to say that our involvement in the monitoring aspect of a case is a little bit less, perhaps a little bit less involved than might be the traditional approach that an insurer would adopt. But nevertheless, we are kept apprised of important developments, and where it's the preference of counsel or the client, we may be more involved in terms of providing our own perspectives or insights as the opportunity is brought to us. So that is the 3 easy steps of our funding process. The next slide gets into a couple of the specific areas that will make an investment particularly attractive to us or a non-starter. And of course, the top point there is that we look for a case that is going to be successful on the merits. That requires that we look into the evidence and carefully consider the facts of the case. We'll do an assessment of the legal theory, look at the causes of action, and see whether they hold together. I do want to take this moment perhaps to put out there that we do not find cases interesting where a lawyer comes to us or a party comes to us and says, we have this, we have this kind of novel idea about a case. That is almost magic words for to prompt us to say thank you for contacting us, but this isn't for us. We don't look for creative new opportunities. We look for cases that are clearly strong, clear winners. And I think it's helpful to make that point to this audience in particular, because we're not in the space of looking to necessarily grow the litigation, the claim market. Instead, we're looking to ensure that claims that have real merit are getting their day in court, and that it's happening in a way that makes sense to parties based on their own risk assessment and their own capabilities. So just going back then to the list of considerations, I think I've already touched upon the fact that we always look carefully at the damages. That can also be a make or break consideration for our investments. We like to invest in a case where there's a relationship between the required investment and the anticipated damages that is at least a 1-to-10 ratio. I mentioned earlier that we think that a typical case is going to cost, as a starting point, $1 million in terms of a budget to pursue the litigation. And so obviously that means that the cases that we tend to fund have damages, expected damages, that are north of $10 million. And the reason that this makes for an important consideration to us is that after we take our capital investment and our return, it's really important to us that the claimant retain the lion's share of the proceeds of the litigation. We're interested in a long-term sustainable litigation funding market. As I've mentioned, the company's been doing this for 30 years. And we've concluded that if we don't have something that looks like that relationship, then it's not likely a case that we're going to be interested in funding, because it might be a strong case, but if we expect to take too much of the proceeds for ourselves in relation to our investment, then that's going to result in in an outcome that we frankly just don't think is appropriate. So few other points there. Council, we certainly are well informed as to the strengths and capabilities of different litigation counsel in the country. And given that we have offices in 18 cities across the world, we've got a really good sense of the strong firms and the best counsel for different types of claims around the world. I will pause to say we don't choose counsel. And I have heard instances where other funders have insisted upon a claimant using a specific law firm or specific lawyers. That's not our practice, and we wouldn't think that to be our preferred approach. But we do view counsel's capabilities as an important consideration when determining whether or not to fund a matter. Last 2 points, I think those are pretty intuitive. We have to be able to realize a return in order for an investment to make sense. And then finally, we're not particularly interested in cases that may drag on for 10 years. Where we have investments that stretch out beyond 3-4 years, we have to price our return accordingly. And so that consideration will impact our comfort level with different cases. All right, so on to the next slide. There are a lot of words here, and they actually do cover a ton of content without necessarily meaning anything on their face. I don't want to spend all of the time that would be required to unpack these completely, but I do want to highlight the 4 points in the left column, namely a risk transfer structure, a risk sharing structure, and portfolios, whether law firm or corporate portfolios. Those being really the key broad strokes funding structures that we pursue. The first one, risk transfer, it should be a reference really to single case funding risk transfer. And by that I mean it's a claim where a party wishes to pursue its action, has no resources to participate in paying the lawyers, and the lawyers, for their own internal reasons or other factors, aren't prepared to engage in a contingency. And so in that scenario, a funder would be paying 100% of the costs associated with the litigation. The risk share model is just as you would think. It's a single case investment where a funder is perhaps paying 80% of the costs of the litigation, with the remaining 20% being either WIP carried by the law firm or perhaps amounts paid by the clients, and usually all 3. And that is the optimal scenario in terms of an investment, because it ensures that the three parties in the relationship are very much aligned in terms of how they're approaching the litigation, with everybody having some skin in the game and everybody having very similar motives to ensure the best outcome that's commercially sensible. So then portfolios, law firm or corporate, that's a different kettle of fish altogether. And a portfolio funding structure is, broadly speaking, a situation where a corporate client or a law firm will group together a number of claims and use that portfolio to collateralize an investment. In return, the funder takes a portion of the recovery from any of the claims within the portfolio. This is an attractive structure because from a company or law firm's point of view, it monetizes an otherwise difficult to monetize asset. It de-risks the lawyers, where it's a law firm portfolio, from cash flow issues. And from the funder's perspective, it's attractive because of the broad range of opportunities from which a return can be realized, the diversification of the claims, in other words. The upshot of that is that portfolio funding will often be offered at a price that's slightly more or slightly discounted to single case funding. So really quickly then, just going down the left column, these are examples of different features that can apply in some funding arrangements. And in the case of the last 2 points, they are different approaches to funding. Judgment and award enforcement is an area that you and your legal teams may have some particular interest in that you may obtain awards against defendants that you then have sitting in your drawer in your office desk collecting dust because nobody's doing anything to chase down the assets that may be in a jurisdiction that, frankly, you don't want to spend any time thinking about. Our company has a highly talented leading enforcement team with a lot of business intelligence types who do effective asset tracing and have a great deal of experience in a whole host of jurisdictions that might otherwise seem like awkward jurisdictions. To maybe illustrate that point, Omni Bridgeway has a partnership with the World Bank where it's our what we call our DARP program, our Distressed Assets Recovery Program, where throughout the Middle East and North Africa, we assist in banks seeking recovery on non-performing loans. And then the last bullet there is just a quick one, judgment purchases or arbitral award purchases. This is something that we're open to. We've in Canada just fairly recently concluded our first judgment purchase transaction. And it's an instance where a judgment is subject to an appeal. The party who won at first instance wants to lock in some return from that. And we looked at the case and are prepared to take on the legal risk of the appeal. And so we purchased, we stepped into the shoes of the judgment holder. Small font, bottom right corner, less common, defense funding arrangements. Nobody has clicked their hand to say, well, what about, you talked a lot about claimants, Paul, what about defense structures? And the simple answer there is that defense side funding is something that we're interested in doing, but it's very difficult to structure in a way that makes sense to people. One of the easiest forms of defense funding is actually the portfolio structure that I described earlier, where claim side claims can be monetized and capital from the claim side can be used to defray defense costs. That's not a strictly speaking a defense funding arrangement. Defense funding arrangements are possible, but as I say, not particularly common. Okay, now the last slide I'm going to be quick on, and then we'll get into the final part of the conversation. Litigation funding, when and where. This is perhaps already implicit from some of my other remarks, but in terms of when we're available to step into a funding relationship, it can be at the beginning, before a commencement of the proceedings, and that's perhaps how I've signaled it to work based on my earlier comments about budgets. But equally, parties will come to us midway through proceedings, after judgment, in the case of judgment purchase arrangements or enforcement issues. And so really we can become involved at any stage. And really, at the risk of stating the obvious, we're content to look at investments or cases that would be before courts, tribunals, really a whole host of venues. All right, so then that's part 2, done and dusted. So then 3, that's where we get into learning to love litigation funding. And I have a feeling that the general sort of level of quiet in the room at this point is just a function of everybody thinking to themselves, yeah, I think I could love litigation funding. Or maybe I'm being too optimistic. The next slide is really intended to speak to the fact that I've already alluded to. The idea of our involvement in litigation, from my perspective, shouldn't be viewed as a cause for alarm that there will be an enormous surge in litigation. Sometimes we'll see headlines in international press that make these kinds of suggestions. I simply don't think it's borne out, at least in the informal data set that I have access to. What I think litigation funding will promote is, as I put it, better litigation. And this itself might be a source of frustration to parties who need to respond to litigation, but I don't think it should be. We, as I point out here, we are very careful in the cases that we fund. We've had over 560 applications for funding, well over, actually now we're probably closer to about just a little shy of 600 since we started operations in Canada. And from that, we've got 18 funded, active, and resolved investments. So we don't jump into things that are speculative. That's point one. We do provide the opportunity for cases, and I see there's a hand up, so I'll just finish this thought. We do provide the opportunity for cases to be carried by effective counsel. Lawyers need to get paid, and the really good ones need to get paid a lot. We can facilitate that. And the simple fact of the matter is skilled counsel dealing with a case will result in a better outcome for the party that they're representing, but also a better outcome in the context of the process itself. Jean-Raymond, would you like to?
Excellent, thank you. Jean-Raymond, please activate your audio. Maybe we'll give it a second, and if Jean-Raymond doesn't come on, you can continue on, Paul.
Sure. This is good. I appreciate the opportunity to rest my voice. Well, let's flip over then to the next slide, and this is what this is a list. I wanted to get up to 10 thoughts as to how your organizations might benefit from funding. The first one is really, is integral to funding. You can reduce your legal spend. It's that, it's that simple. If you're being funded by a third party, you're not using up your own resources. The second point has to do really, I suppose, more with an accounting consideration and the recognition of costs versus revenue in terms of litigation spend versus claim outcome. The third category, this is something which your organizations will already be extremely adept at, case assessment. But I think nevertheless, there may be instances, in particular in the most high profile matters, where a party with a little bit of distance from the case can offer some useful input and insight. On item 4, this may be a different consideration depending on the scale and internal resources of your organization. But we do, we are certainly at the ready to assist where we can in terms of keeping cases on track, as well as providing that sounding board that I referred to earlier. Item 5, judgment enforcement expertise. I think I've already highlighted that. 6 on the list is just a specific area where you might actually have claims that would where there could be an appetite for you to look to sharing the risk of pursuing the claim. And then the final point is, I suppose this is an opportunity that you have to recommend or propose litigation funding as a strategy or as an approach for either your own preferred counsel doing work for you, or to the extent that you're providing support to clients in a manner that's intended to be advisory or to deliver value-added advice. It can be useful to suggest litigation funding as a strategy that may simply have never occurred to them. Now, the next couple of slides, I think we can probably breeze through. The gist of the point here is that if you or if anyone in your universe is interested in understanding litigation funding better, or interested in a conversation with partnering with a litigation funder, we of course believe that your first port of call ought to be Omni Bridgeway. This slide talks a little bit about our experience, the depth of our experience, and our history. The next slide talks about the successes that we've enjoyed in terms of cases that we have invested in. And the next slide is just one of those run-of-the-mill. These are the various accolades that we receive. While I call it run-of-the-mill, I do take considerable pride in the fact that clients with whom we work and partner have spoken very highly of the experience. And that's not just because we provide free money. You're usually popular if you do. But indeed, beyond that, we are understood to be decent people to work with, intelligent people to partner with, and generally eager to help. So that's the purpose there. So that brings us then to the very end, and an opportunity for any questions that haven't come up, and failing that, an opportunity for everybody to capture some free time. And I see a question.
Yeah, Alistair, please activate your audio and.
Thanks so much for this fascinating presentation. I'm kind of taking off my PACICC hat and putting on a previous hat, as I was at an insurance company when we had one of the larger Canadian class action events. And I think, so I'm speaking about the listeriosis case in Maple Leaf Foods.
Yeah.
And I have used it since to articulate the maybe too narrow thinking virtues of Canada. We had the CEO apologize, and we ended up in less than 18 months, all the way through to complete resolution of the class action in a way that was widely regarded as being effective, with less perhaps than the normal share to counsel, a much faster resolution for those unfortunately affected by the case, and at a much lower cost to all the folks involved. I was one of the insurers in the tower, and so it was very much on my mind. So to the extent that the arrival of firms with the skill set and experience and track record you folks obviously have, getting more engaged in the Canadian market, how should we as insurers be thinking about the downside risk that you are going to contribute to the Americanization of a Canadian judicial environment that we think has probably worked out pretty well from a public policy perspective?
Yeah, that's a very well articulated question, and I think I can answer it, I hope, in an interesting way, which is to say that I may be wrong, but I think maybe Liz Bacher at McCaig Borlaug was what counsel for Maple Leafs on that. I believe I haven't been involved in the case at all, but I know Liz quite well, and her husband, who's in the senior legal fellow at CIBC. Why do I say that? It's because we, the folks at Omni Bridgeway, are part of the Canadian litigation community. So we don't, I think it's useful to appreciate that we as an organization don't charge in like a bull in a china shop and think that this is how things ought to be done and bring a sort of a gunslinger's attitude. It was really interesting listening to the Twin Towers litigation discussion, because I found myself thinking that we, Omni Bridgeway, wouldn't have ever touched that case because, and this goes back to a comment that I've already made, it really seemed to introduce a very novel and perhaps grasping notion that there were two events, and a certain stubbornness in terms of litigation strategy. That's just not the type of investment that would be attractive to us in any way, shape, or form. I would also maybe put out there, just back to the sort of cultural point, to highlight that our company is a publicly listed company. We're based in Australia, and we do, I think, as I've come to learn, share a lot of cultural commonalities as well as legal commonalities with our cousins in Australia. And that is a view that you want to get to the right result, but usually it's not a zero-sum game or a scorched earth strategy. So I throw those observations out there as an effort to sort of highlight that we're not informed or influenced by a particular mindset, other than, I think, to suggest that that meritorious cases should be where they're unable to be settled amicably, should have an opportunity to get into the courts to be adjudicated. And from where I've been sitting in both the defense and the claim side of my legal experience, that's a little over 15 years. I think I maybe made myself seem more youthful than I clearly am. I don't have the view that Canadians are hardwired to litigate first and ask questions later. And that certainly wouldn't be our investment strategy. So I hope that helps speak to the question.
I think we're probably going to draw this to a close, Paul, because we've gone over time, and certainly appreciate your time here. I look at this as really a professorial explanation of third-party litigation funding, and I guess I was remiss in earlier saying it was a disruptor. You've explained both sides and shown that it really is a tool for the industry and something that is very valuable. And now if I could just ask everyone to stay on the line. So thank you very much, Paul. I'm just going to ask Danica to put up our last couple of slides, and it's really worth staying on the line for a minute. I want to thank all of our speakers, Mark White from FISRA, Stephen Dishart from Dishart Communications and Crisis Management Consultants, and of course, Paul Rand from Omni Bridgeway Canada. I want to thank Danica for her work in helping coordinate the slides. Invaluable today. Thank you so much for that. And Alistair providing an update earlier on PACICC issues and activities. Alistair's a long distance runner, and he will tell you that it's very important to finish a race with a kick. So we're certainly doing that with the Risk Officers Forum to finish the year. Here are our last two events of the year. Wednesday, October 2021, we have an emerging risks webinar, and please mark your calendar. The last Risk Officers Forum meeting of the year is Friday, November 6th, and the next slides will explain this. So let's go to the next slide, is our October 21 webinar. So on October 21, we have Frank Chong. So Frank Chong, is the new chair of the CCIR, the Canadian Council of Insurance Regulators, and there we are. He's also Vice President and Deputy Superintendent Regulation for the BC Financial Services Authority. And Frank, yesterday, agreed he's going to speak at our Emerging Risks webinar on the topic CCIR, current issues and industry priorities. So you have, through your ERM surveys, said to us that government regulation is an issue. We'd like to hear more about that. So we thought we'd put that on the fall program. So that is very good. That'll give you a cross-Canada checkup from Frank, coming in with a new mandate and perhaps new priorities. So he's going to talk about that on October 21. And then our November 6th, last meeting of the year, last forum meeting, we have two speakers. David McNaughton is going to be our keynote speaker. He's president of Palantir Canada and a former Canadian ambassador to the US for the years 2016 to 2019. David's going to be speaking about risks facing Canada. And then also through our ERM surveys, you've told us that you want to know more about, you see as emerging risks over the next 10 years is a lack of talent in the industry. So we're bringing in Jeff Shields, Senior Vice President with the Insurance Division of Strategic Resource Consultants, Inc. He's going to be talking about the risk of talent shortages in the P&C industry over the next little while. We always try to coordinate our last Risk Officers Forum meeting of the year to coincide with OSFI's Risk Management Seminar. And interestingly, just today, this afternoon, OSFI has released a hold the date reminder. It is taking place that morning. I coordinated this with OSFI. So their seminar is from 10 till 12:30 that morning, or it might be 9 till 12:30, sorry. That morning of the November 6th. And then the afternoon, we're going to close with our risk management seminar. And I'm going to be coming to you shortly with satisfaction survey. I'll do that tomorrow to get your thoughts on today. We welcome your feedback. We want to enhance the quality of future broadcasts and certainly invite your thoughts on future speakers and subject matter. And we are going to be having a panel on Friday, November 6th to close the day. And that's going to be our industry panel, talking openly about what they heard that morning from OSFI in the risk management seminar. So with the reminder that I'm going to send you tomorrow, the satisfaction survey, I'd ask if you want to sit on that panel and help coordinate discussion from the industry. It's going to be online. It's going to be a Teams call like this, but we're looking for 3 panelists from the industry and certainly want to keep everybody engaged. So if you want to be on that panel, you've been to previous Risk Officers Forum meetings, and you've seen how their job basically is to continue to fire questions at the audience and to engage and solicit opinion from members across the industry. So we certainly, I'd certainly appreciate if volunteers want to step forward and say, I'd love to be part of that panel. Let me know, drop me an email on that. I'm thanking everybody, and I want to thank you for joining us here this afternoon. That concludes our meeting. If it was your first time, I hope you found it informative, and if it was you've been with us before, certainly hope you found it again informative. We look forward to having you join us with our webinar in October. In the meantime, stay safe, and we hope to see you soon. Thanks for being here today.